Hello. Good afternoon, everyone. Welcome to PDS Investor Day. Kindly keep your phones on silent mode. We have a Q&A session planned at the end of the presentations, so please hold your questions for that session. I would now like to invite Group CEO Sanjay Jain to open the event.
Hi everyone, very good afternoon. Thank you so much for coming in. Third year in a row, it's a privilege to do this Investor Day. And can we have the slide with the agenda for the day? So I'm not going to take more than 2 minutes of your time. We have requested a senior leadership team to fly in and interact with you over the next 3 hours. So we have Palak Seth presenting the overall strategy, business update, and what lies ahead for us. As you know, we sell half of our revenue to UK and about 25% to Europe and about 20% to US. So as a result, we have carefully curated and requested Anuj Banayak from Poetic Gem, UK, who has flown in and will share a perspective of our interface with customers in UK market. My colleague Safak, because of some visa issues, could not travel from Istanbul, but he also interact with key customers in UK. So between Anuj and Safak's presentation, Safak has a video that we will run for you. We are trying to address half of the market where we sell. Then we have Michael here, who is going to give an insight into how PDS is addressing North American market. And likewise, I have my colleague Rajiv Ranjan from Düsseldorf, Germany. We're in EU, which is about 25% of our market, and Germany is one of the key markets. So our speakers are going to pretty much cover almost 90% of where we sell. And two more important things is Abhishek, who's my colleague heading the manufacturing business. So we have him presenting to you what are we doing in our 3 factories. And finally, and very importantly, PDS Ventures has been an integral part of our functioning, and we have Ankur from London covering that. So we have tried to cover all facets of our PDS pursuit. And of course, no presentation is finished unless the CFO comes up and say this is how it adds up. So we have Sadiq coming in. And the next one, so while today we have the opportunity of interacting with you during the Investor Day. Next slide, please. In almost a month from now, we would like to invite you to Bharat Tech's in New Delhi. We've been again privileged for third year in a row to be one of the title sponsors. And this is from July 14th to 17th. And more details would be disseminated through our LinkedIn page and also otherwise as well. We request all of you to please come and make a visit to our stall in New Delhi. So with that, I hand it over to Palak. And Shirley, are we playing the video before that? Yeah, so we have a short video of about 3-4 minutes covering a PDS oversight, and then I'm going to request Palak to come up. Thank you.
Over the years, the fashion industry has been transforming. Trade routes shifted. Consumer expectations evolved. Supply chains faced unprecedented challenges. Through every change, one company didn't just adapt, it led. What began as an entrepreneurial vision has grown into one of the world's most significant global fashion supply chain platforms. Today, PDS combines the scale to serve global brands with the agility to keep moving forward. But scale alone has never been what defines us. What defines us is how we work. PDS does not operate as a traditional holding company. It actively participates in creating value by empowering its businesses through capital, capabilities, and connectivity, creating ecosystem advantages that drive innovation, accelerate growth, and enhance value creation across the portfolio. We are a services business with product at heart, and we partner with our clients in 5 distinct ways. Our manufacturing arm operates 3 world-class facilities across Bangladesh and India. As a design-led sourcing partner, we bring together design, product development, and sourcing expertise to take concepts seamlessly from creation to commercialization. Through sourcing as a service, we operate as outsourced sourcing office for a particular region or category. Through category management, we act as outsourced buying department for a particular category. And through our brands division, we run and operate brands both as owners and as licensees, partnering with global IP firms. 5 solutions, 1 platform, built entirely around your needs. And the real measure of the model is who it serves. From brands to the world's biggest retailers, they trust us. We deliver across every major category: apparel, accessories, beauty and wellness, homeware, footwear, and general merchandise, with the global reach to source and manufacture wherever our partners need us. And as the world is changing, so are we. We're expanding our sourcing footprint, accelerating digital transformation, embedding AI across our platform, and strengthening our commitment to a more sustainable future. A robust business model that balances entrepreneurial spirit and enterprise risk management. Guided by 4 sustainability pillars: respect water, reduce emissions, think circular, and build community, we are driving measurable change across our value chain. Through PDS Ventures, our $50 million strategic innovation fund, we invest in the technologies shaping the future of fashion, from regenerative materials to circular solutions. Technology and AI enablers of fashion and retail industry. Today, PDS is helping shape conversations across the global industry. We've built something rare: the strength of a global institution, the spirit of entrepreneurs, and the ambition to keep moving forward. Together, we're building a better, more sustainable supply chain. PDS, built for what's next.
I would like to invite Parth Gandhi, who is one of our board members, and now over to Palak.
Hi, it's working? Yeah, thank you. So, good afternoon everyone, and thanks for taking your valuable time to attend the PDS Investor Day. It's the 3rd year in a row we are doing this presentation, and gives us the opportunity to showcase, where PDS is heading, what the business is, and how we are positioned to win in a very challenging environment. So I'm going to be covering a few things, followed by some of our partners who will be covering the rest of the topics in more detail. So a lot of you are new in the room, and many of you probably don't know about the PDS business model. So we thought we'd cover some of the basics, and then we get into the detail of how the business is operating and how it's set up. So the big picture, what business we are becoming. So if you see, in the middle, PDS is the logo, that's PDS, and around this are around 40 business verticals led by industry-leading experts who are equity holders with us. So it's really become a platform, a global platform with many capable management teams who are shareholders with us running these various verticals. So what does the platform do and what do the businesses do, right? So the platform, which is the business, the PDS platform, it focuses on banking, treasury, IT, HR, legal, and compliance. So they're the core functions of the platform. Recently, we've added growth and partnerships because, the job of the platform is to enable and support our businesses, but govern and control for risk and reputation management. So growth and partnerships is a very critical path where we are able to bring in a lot of new customer opportunities and feed our existing businesses. I will talk more about this in further slides. And what are the subsidiaries doing? They are focusing on the customer. So the way we are set up, there's zero distance between PDS and its customers. We work with 300 retailers and brands. So the way our organization design is, every customer gets a service of an entrepreneur, not a large organization. So the subsidiaries are focused on design, development, critical path management, manufacturing quality assurance. This makes our business model highly scalable, but also highly personalized to the global customer needs. So just numbers you saw in the video as well. So we do around 2.2 billion in GMV, which translates to 1.5 billion in invoice turnover. So that's our invoice turnover for last financial year. We are fortunate we have very large working capital limits from the banks in Hong Kong and Dubai, around $550 million of working capital limits. That's the fuel of the engine, right? That enables us to run this business efficiently. Pre-COVID, around 5 years ago, we were almost 100% apparel. Now we are approximately 75% apparel and 25% non-apparel, which is very quickly we have migrated and diversified our business from just being a apparel solution provider to home, general merchandise and other categories. We are a very global business. We are 22 countries in 100+ offices. So, we are able to manage such a large business because if you're a global partner to big retailers, you have to be in the right country with the right product in the right factory. So when a big retailer meets us, we tick all the boxes. We are volume based, close to 1.3, 1.5 million pieces a day. So that's huge scale we bring to both our purchasing side, but also on the customer side. We work with 300 retailers and brands and around 12,000 people in our organization. I would say around 9,000 in our factories and 3,000 in the sourcing business. So, we are a product company at heart, but we are really evolved into a services business, right? So we are probably the only global services business in our industry, which puts us in a very unique position. And what are the services we give? When we talk to our customers, they are the 5 things PDS does. One is our manufacturing business, which Abhishek will cover in more detail, right? Second is our design-led sourcing business, which is a full vendor model. So we engage with a retailer like Primark, Primark then engages with PDS. It's an asset-light model. We approve 40 factories across the world, and then we design and develop into the retailer's private label and source from those 40 factories. Becomes highly asset-light and highly scalable business model, which is the core of the company where it was started. Third is sourcing as a service, which basically is nothing but retailers now outsourcing the sourcing operation to companies like PDS. So there was a way where they were outsourcing IT, outsourcing finance. PDS invented sourcing as a service around 4 years ago and become industry standards. So many retailers today are saying we don't want the headache of having few hundred people in Asia in 10 countries. If PDS can do that for us on a cost plus model, it enables us to run retailer sourcing operations. It's been a huge unlock and it's been a great way we have moved forward as a business. Then category management is where retailers are outsourcing their buying departments. So they're like, we don't need to have buying teams. Anuj will cover category management in more detail. How Poetixem today is managing the entire category for a big retailer, and there's no order-to-order negotiation. And finally, the brands business, we work with either licenses or own brands. So based on a customer need, there are the 5 things we are doing for a retailer at this stage. And all run on a PDS platform with a strong leadership, ESG strength, financial strength, and is tech-enabled. So what are our advantages? What sets us apart? So, the C-suite leaders, the world's largest retailers and brands management team, from a Carrefour to Asda, Tesco, Sainsbury's, Next, the biggest retailers, the leadership of those teams engage with PDS, and then we understand their needs and provide bespoke solutions. So being a product business at heart, we are really a solutions business and probably the only solutions business in our industry that has emerged. And why do the customers choose us? I will talk about how many new customers we have onboarded last 2 or 3 years. But we always say we are a 25-year-old startup, right? We move fast. We listen to our customer needs. We have a scale of a listed company, but the agility of a startup, right? So that makes us to move very fast based on our organization design. We are doers. We just don't, discuss, but we execute. So customers always say PDS is very strong in execution. Opportunity comes, you guys have the ability to execute very quickly and to scale. Third is we attract the best talent. Subsidiaries, our subsidiary CEOs are owners of equity, which puts us in a very unique position. We offer unseen transparency in the industry. Being radically open on commercials brings high trust. That's why retailers are giving us these large contracts because they have transparency how PDS operates. And then they have very big, comfort on our compliance policies. So the way PDS operates, zero tolerance on ethical social compliance becomes a very important way we engage with our customers. We offer transparency and we manage risk on their behalf. And finally, we are tech-enabled. We are investing a lot in AI solutions and starting design, order management, documentation, and impact and result of that we'll see in the next couple of years. So very few businesses today would be able to recreate our model, which is what made PDS one of the 2 global players globally. So today, proudly we can say, we are a 25-year-old company. Our biggest competitor today, probably Li & Fung, is a 120-year-old business. So PDS directly competes with them, and we feel we win because our organization design is flatter. We are a platform. We've got great entrepreneurs running it. Whereas Li & Fung being a hierarchical organization, having 4 presidents, our model is very unique and it's almost impossible to replicate, right? So that has been a big strength of how we've set up the business. The organization design of PDS offers equity to people to come and run, which gives us a huge, kind of strategic advantage. So just in the last 2-3 years, right, the quality of management teams which have joined us, like these all colleagues were all ex-retail directors. Many of them were our customers. They saw value to leave a large retail organization, join PDS and set up businesses. And many of them have joined on the recommendation of our customer. For example, Chris Bath on the bottom left, he was in Sainsbury's, set up the entire global sourcing of $1 billion. Sainsbury's said we have to, cut costs, we have to restructure. Food is going to be our priority and apparel is not. So PDS, we're doing 40 million with you, we want to do 150 million with you in the next 2 or 3 years. Can you hire Chris to give us more confidence? So then, that's how a gentleman like Chris joined us. Michael, who will be presenting later, was offered a position as president of Li & Fung, but he chose PDS to partner with us versus joining one of our biggest competitors. So similar stories with everyone, right? We've got great talent, who have joined PDS, and the impact and I would say the inertia of this will start showing in the next couple of years. I don't think any company in our industry can showcase leadership that we've got, and this is just a snapshot. So market, what we are seeing, right now there's huge disturbance. So I would say every crisis brings opportunity, and when things are status quo, nothing moves, but we like crisis because, we've come out of crisis winning. When COVID happened, we came out stronger. So whenever crisis happen, PDS comes across as a stronger business. So in this, how does this benefit PDS, right? So starting from geopolitical instability and tariffs, customer look for country of origin diversification. We are in a very strong position to offer that. Every retailer in the West, from UK, Europe, and US is cutting their own costs, cutting design, cutting sourcing offices, and PDS outsourcing model becomes highly attractive. Today, a retailer is not chasing a factory in the middle of Asia. They're chasing companies which can provide solutions. And in an industry which is, highly fragmented, PDS is an aggregator of great talent, great businesses. So we become a natural solution provider. There's a vendor-based consolidation. PDS has seen a financially stable partner. Not too many vendors can take on a $100 million business in year 1 and execute it. Our customers know PDS can do that. And when the C-suite of big retailers want to outsource function, they want to work with companies which are safe. So that helps us a lot in many ways as well. Consumer sentiment is down, right? The value segment is winning, and PDS core customer base is the value segment. And finally, there's order size reduction, and we have set up a fast production business model which in 2 years has reached almost $100 million scale. So there's something, the macroeconomic environment is really playing in our favor, which is great news for companies like PDS. So the next few slides are a bit important and I think a little bit busy, but I want to go through it. Just we are covering business update, what have we achieved and what we are focusing on now as a business. So we talk about this every 12 months publicly in these kind of forums. So a lot of discussion on new business. PDS has been burning cash in setting up new business in the last 5 years, right? And our profitability has been depressed to a certain extent. But it is with design that we have done consciously, being the largest equity holders in the business, seeing how to run this company for the next 20 years and make it more successful and resilient over a period of time, right? So I'll just showcase what has happened. So we've divided this into 2 cohorts, 21, 23, right after COVID, what we did, and then 24, 26. So I'll first talk about the first cohort. In 21, 23, we started 14 new businesses. This is across PDS and our subsidiaries. So some of our partners started businesses. So we started 14 new businesses. Out of that, 10 have worked and 4 we have closed, right, which we saw was not working. The reason they have not worked because they didn't have the customer engagement they were expecting. 10 have worked because customers saw value in those business partners who came in and helped us to establish those businesses. So up to 2026, from 21 to 2026, in those 5 years, we funded losses of 18 million, direct hit on our P&L by setting up those businesses. But net, when I accumulate those businesses, we made a 22 million profit. So say out of 14, some worked, some didn't work. So 18 million P&L hit and 22 million was the profit. And net profit PBT was around 4 million positive. But the most important factor that we established 10 new verticals which are highly engaged with management teams, which are going to now deliver exponential profit in the next few years. So we are expecting that, by 2030 and starting now, these businesses we set up in 21 should give us a $300 million top line with a 3 to 4% bottom line, right? So in perpetuity, 12 to 14 million, between say 11 to 14 million bottom line we'll be getting from this cohort of businesses we established. But I had to take a P&L hit. And the reason they were established because the market was going in a certain way, and PDS to become the second largest global player, you have to evolve from where you are. So it's done by design, right? Here, so just what we saved, if we had to buy this turnover, right, like say 9 million bottom line in current financial year, we would have paid $45 million in acquiring businesses. But more importantly, I would have paid people to exit. Instead, we funded losses of 18 million, right, and we saved 27 million. So problem is 45 million would have shown in my balance sheet. Here, 18 million is hitting my P&L. But still net, we saved 27 million if I had to acquire that turnover versus build that turnover, right? So what we achieve, we partner to grow, then pay to exit, which is very important. And then secondly, we recoveries within 4 to 5 years, and returns are up to perpetuity and avoid any upfront cash requirement. So, this model is definitely, I would say much more superior to buying businesses and paying people to exit. We firmly believe partnering to grow in our industry is important because our industry is about ecosystem, is about trust and confidence between buyer and seller. When someone sells a company, it's difficult to replace those relationships versus, where you have partner to grow, which is much more sustainable in the long term. But more importantly, we moved from, this is during COVID time, we moved from just being a supplier to become a global player, right? So we established the sourcing as a service model that did not exist in the industry. Today it's become the industry benchmark. Any global sourcing deal that goes, customers demanding, give us a cost plus model, and PDS established that sourcing as a service. Second, we expanded our US geographical footprint. Before COVID, our US business was less than 1%, right? Literally now, in the last few years, in 5, 6 years, it's 20%, and we feel it could become half a billion in the next 3 to 4 years based on the traction we are seeing. But it all takes time to build. We diversify non-apparel categories. Before COVID, we were 100% apparel. Today, we are 75-25. So 25% non-apparel. We lay the foundation for moving product to a solutions business. Today, when I go to a customer, I have my 5 solutions, and I would say 9 out of 10, they onboard PDS as a vendor. I'll show you the customers we've added because they see some angle to engage with us, right, which is great. And expanded wallet share with existing customers. So this is what we did in 21-23 cohort. This is the 24-26 cohort, the last 2 years, where we've seen a little bit dip in our profitability. So we started 23 new businesses, right? Out of the 17 are running, 6 we had to close. Up to 26, we have funded loss of 30 million approximately, right? Almost out of 30, 19 million has been the brand's business losses, which we have now taken action to restructure. Out of that, Ted Baker was 12 or 13, rest of a few more brand businesses. Traditional design-led sourcing a service loss was much less, right? But now we have reached a stage that in current financial year, 2026, most of these businesses have become profitable and started delivering the bottom line we require. So current financial year, the business we had started 2 years ago will give us 100 million bottom line, and overall as a portfolio has become positive. So we expect that, in the next same trajectory, 21, 24 to now, these businesses will give us 10 to 12 million bottom line on perpetuity, but establish many new entrepreneurs on the platform to run and perform, So this has been, but now our focus has been, we are not planning to open any new business which requires loss funding. So, we have a new investment policy that Sadek will showcase. So unless we see clear visibility of top line, bottom line, or a signed customer contract, we are not adding new businesses. And any new opportunity, we are feeding our existing business partners. Because when you saw the earlier slide, the capability of management we've got, people who have joined us have handled multi-billion-dollar business in the past, right? So they have a huge scope and management bandwidth to grow further with us. And finally, we've feeding our existing businesses to existing customers. So what this cohort did, we became a top global player. I couldn't say that in 24, but today, PDS, we can proudly say any global contract that comes, there are 3 or 4 companies in the industry, PDS and Li and Feng, and we'll showcase some of the wins we've got. So organically, partner to grow, not pay to exit, invest through P&L, not through balance sheet, taking conscious decision of, in building this business for the next 20 years, not next 2 quarters. We took those decisions and became a top global player in our industry, which is respected by many stakeholders. Our US market accelerated, SaaS model got established. We got the learning from the brands business. We lost $19 million, right? But we've restructured most of them now, and we've got the learning what worked, what doesn't work. And finally, category management as a new service offering was established, which is working well. So on the customer side is important, right? That all this new transaction in the last couple of years. So I mentioned, PDS has established a growth and partnerships team. It is sitting between Hong Kong, London, and New York now. So this team's job is to pitch for new opportunities to new retailers and feed our existing verticals, right? So when the opportunities come, there's a very highly capable team. I'll show you what we've achieved. So the job is to engage with global customers, which are either existing customers of PDS where we have not engaged them and showcased our full breadth of services, or new retailers we want to add on board. So this has become a highly effective engine of the company and achieved great results. So this is new news, but we have successfully signed in the last few months, we announced one, but 400 million of new sourcing as a service contracts, right? Where obviously it's like on a cost plus model. We expect this to give us a $7 to $8 million net profit, but because this sourcing as a service, there's infinite ROC and zero working capital. So we announced the first one on the left, which was a North American-based, retailer called Family Dollar. We just signed the LOI and head of terms for the French hypermarket, $280 million sourcing as a service with a $3 million bottom line potential. And we're in the process of finalizing, and that's why we're confident of announcing another $50 million opportunity with a UK retailer, which is sourcing as a service but on open margins. So we feel the 7-8 million new bottom line will be added to the company. This is all effort in the last 6 months, right? But because now we have the capability of management, we engage with the retailer, they see the quality of people we've got, and they're comfortable giving these large chunks of business, not only becoming another factory or another supplier. Then secondly, we've opened a lot of new accounts. So last 3 years, many new accounts have started, which normally only work directly with the factory. So like people like Ralph Lauren, Target, Walmart, M&S, PVH, H&M, Burberry, so on. These retailers will only come to you if you are a factory in 99 out of 100 cases. They made exception for PDS. They've seen the quality of services we offer, either sourcing a service or design excellence or category management, and they've opened our account without having us to showcase factory capacity. So, if you're a manufacturer, you have to put in an asset to grow. Here, they look at our capability and our management and they open an account and talking about large businesses. So, and most of this feeding is happening to existing verticals, which will then scale up over a period of time. So I don't think any business today in our industry can confidently say that, in a market where there's consolidation, a lot of new accounts for PDS have been opened, which is not easy. And similarly, there are a lot of other businesses which we are feeding existing businesses. And these numbers are not come from thin air. This is where we see visibility next 2, 3, 4 years. And these are all new accounts. I'm not talking about existing business. So, all the investment in people, services has helped us to really, move the company to become a dominant global player. And then finally, when someone asks me what can bring PDS down, I said the only thing that can bring me down is risk and reputation management. Because end of the day, we have no people dependency, no bank dependency, no customer dependency. We are highly diversified. Normally, a large manufacturing group will have 3 customers, 80% of the business, right? Whereas in our case, our largest customer at the group level is 7-8%. So a highly diversified model, no dependence on a particular subsidiary. Largest subsidiary could be 10-12%. So, PDS will continue operating for perpetuity until something happens to our reputation, right? Which also we very guard and manage very carefully. So on that side, there is a lot of risk in the industry, but PDS has done architecture that engineers out most of the risk from the industry that it takes. So on the inventory side, we don't take any inventory risk. Everything is pre-sold and make to order. We are very strong and very careful on credit risk, right? So there have been certain bankruptcies in the industry in the last 2 or 3 years. Not even a single bankruptcy. We had a credit risk or a hit on PDS on our payables. Yes, we lost gross margin because, Mr. Rajiv Ranjan will cover on Germany. One of his biggest customers, Gary Weber, went bankrupt. He will showcase how he managed risk. There was a hole on gross margin which is covering now, but we didn't have a single hit on our P&L or balance sheet where customer goes bankrupt and PDS has a hit because of the way we manage risk. We don't take any currency risk, we hedge immediately, but most of our selling is in dollars. We don't have any country dependency. Few years ago, Bangladesh was large part of our business. Bangladesh, as far as we are concerned, is fully stable and completely operating normally, but we have so much more country of origin diversification now as a company, which is great. We have no buyer concentration risk and we have no quality rejection risk. That's 0.001%. So we've taken a lot of risk out of the industry based on our operating model, which is I think, keeps our model very resilient. And finally, this is a slide I saw the CEOs of big retailers that why should they partner with PDS? Because, we as a business have very strong controls in place. We have whistleblowing investigations, employee misconduct investigation, business intelligence gathering. Every single email ID of PDS has got NAVIX, which is Global Ethics Hotline. We do Deloitte reference checks and code of conduct training. And we are very proud to say, we should have put that slide, Sanjay, that PDS did a great place to work survey in 12 countries with 97% participation. Every single office certified as a great place to work. So, this is like a random survey we do every 18 months in a tough environment where we are putting a lot of pressure on our people and a lot of companies are in trouble, but unbiasedly, our colleagues rate us as the best place to work. And I think a lot of that has got to do with our culture, as an organization and the values we bring to the people who join us. So finally, we covered this, we try to keep building our reputation globally as a business so that we are visible. I think my biggest problem today is that everyone knows Li & Fung, not too many people know PDS, but being on these kind of, global events helps us to gather and improve our reputation. So if any RFQs are coming, we're invited to those as well. So where will we grow from here? 555, something we talked about, I think is very much achievable. But again, no growth for growth's sake, working with AAA customers, focus on high return capital opportunities, and no compromise on 6 C&I principles. So we could be running 1 or 2 years behind, but still we feel, and the conviction is in the management that we are in a stronger position now than we were 2 or 3 years ago to move to that journey, based on what we have achieved on the customer side, the partner side, and the way we've operated our business. And finally, how will we get there? So what we are chasing is profitability, right? There was a lot of investment to move the business model from just being a supplier to be a global player. So profitability, feeding our existing businesses, because now I've got a lot of management capability within our verticals. Some of them we'll be presenting today. So you'll see that, I don't have to go bring new partners. There are enough good partners in the company who run the businesses. There's a strong pipeline of customers. We just saw that, right? Some big names, multi-billion-dollar company that, are doing procurement, have open PDS account. We got top industry leaders in our company to join, and any new business only as a guaranteed contract or SaaS model. So we are not setting up new entrepreneurs unless there's clear visibility. So that $40-50 million last 5 years we did to build what we have, we don't need to do that again. So that investment cycle is probably peaked and is on the recovery stage. And what we are avoiding is new business investment without contracts, risky credit risk customer and customer base, and any inventory risk. So we stay true to our 6 C&I principles. So this was just a little bit about where PDS is going, what we've achieved, where we see we go from here. We are very confident, as a business that the foundation is there, and a lot of people say that you should think about the company, as a person who's going to run it for the next 10, 20 years. And we feel more confident now than ever in the past that we are in the right trajectory. And if my customers are engaging with us, best people are joining, and commercial banking are giving us almost limits we require without question, that's, I would say, the proof of the pudding of a great successful long-term business. So just and we'll be happy to answer questions later in the Q&A section. Thank you.
Thank you, Palak. The next presentation is by Ankur Agarwal, Head Investments, PDS Ventures.
Thank you, Shirley. Thanks, Palak. So as you know, I manage PDS Ventures, which is the investment and innovation arm of PDS PDS Group. When we think or talk about any venture fund, the few things which come to our mind, it's an early stage investment. Yeah. Few things which come to our mind is it's an early stage investment. What are the risks associated with it? What are the financial returns? All these are very important. But PDS Ventures was built around a broader objective. It was designed to strengthen our competitive position, to attract new customers, to deepen our relationship with existing customers, get access to new innovation in our industry, and pave the way for financial returns eventually. As for any other CVC, the question also remains, how does it flow into the strategic vision of the larger group? So in the next few minutes, I'll try to explain the vision with which our founders started PDS Ventures, the impact that PDS Ventures has had on the group, and how we believe it has become an important and strategic asset of the group. Before that, I'll just run you through a small video on the overview of PDS Ventures.
The fashion industry is at a crossroads, and PDS Ventures are paving the way forward. Not only are we investing in ideas, we're building a smarter, cleaner, and more connected industry. As the innovation and investment arm of the PDS Group, we combine fashion expertise, technology, and sustainability to transform how the world designs, manufactures, and markets. Through our PDS Group network, spanning over 250 global brands and retailers, and more than 700 factories across 24 countries, the group gives us a unique vantage point to spot promising startups early and the expertise to turn bold concepts into global success stories. At PDS Ventures, we carry forward the entrepreneurial spirit of our parent company as our $50 million fund invests in early-stage startups, backing the innovators who are redefining the future of fashion and retail. Whether it's the next iconic piece by a luxury house or a timeless staple from the high street, one thing is certain: fashion will always be part of our lives. That's why we believe in game-changing solutions that make the industry better for people and the planet. Our areas of focus span the whole value chain: material science innovation, next-gen materials that replace the old with more sustainable alternatives, smarter manufacturing that saves time, cost, and carbon, circular solutions extending the lifespan of products, including reuse, resale, and recycling models within businesses, transparency tools for total supply chain visibility, fashion technology that brings creativity and efficiency to life. But here's what makes us different. We don't just fund ideas, we make them real. Our startups tap into the full PDS ecosystem as we support global scalability, product validation, and direct access to the brands and manufacturers that matter. As part of the PDS Group, we are able to offer a one-stop solution for brands and retailers to gain access to the latest innovations in the fashion value chain. Our key partners include Positive Materials, a Portugal-based PDS Group subsidiary that incubates materials science startups by developing yarns, fabrics, and testing garments to bring innovations to market, while Yellow Octopus Circular Solutions are advancing the circular economy by enabling large-scale resale, recycling, and upcycling initiatives. At PDS Ventures, we believe innovation is only powerful when it makes an impact at scale. Ready to reimagine fashion? Let's build it together.
So when we launched PDS Ventures in 2018, the goal was not to simply become a VC investor. The goal was to strengthen our competitive position in an industry which was undergoing significant change. Sustainability, circularity, digitization, artificial intelligence was increasingly becoming more and more important for our customers, which were the brands and retailers. And that led to the creation of what we believe is the only structured corporate venture capital arm in the fashion supply chain. Over the past few years, we have invested minority check in 80 plus startups across the overall fashion value chain, starting from material innovation, which are basically innovations producing sustainable, bio-based, having a positive impact to the environment in terms of having an alternate to traditional raw materials like a cotton, leather, or a polyester, to manufacturing solutions, which basically increases the efficiency in the manufacturing stage. To just give you an example, like we invested in SmartX, which is a hardware and a software company using computer vision and AI to detect the defects in the circular knitting stage itself, which reduces the defects carrying over to the garmenting stage and unlocking the ROI for brands and manufacturers immediately. We also cover circular solutions, as it was mentioned during the entire video also, which gives brands an alternate option rather than an incineration or a landfill for their overproduction. And then finally, the traceability transparency also, which is helping brands align with the upcoming legislations in terms of traceability and transparency, like a digital passport, which helps these brands and retailers, gives a full visibility to their end customers with respect to where their garments are coming from, where are they made. And finally, the technology and artificial intelligence enablers across fashion, consumer, and the retail tech side. So coming back to the question of why did we start? What was the strategic rationale behind PDS Ventures? The goal was to basically create that customer stickiness through innovation, attract new customers, and be at the forefront of future fashion ecosystem. To attract new customers, I think one way is to obviously to invest in greenfield factories, having that capacity, and then create that stickiness with customers. But what we chose was to invest into innovation, relationship, and future capabilities. This basically helped us have a differentiating factor of how our brands and retailers were viewing us as compared to our competitors. They looked to us as a future-ready and a future-ready partner to work with. That kind of opens a lot of strategic doors at the group level. It also has enhanced our brand perception, where we as a group are seen as a leading innovation partner in the fashion industry. Very important is how we invest. The investing model differs largely from a traditional VC investor. We do not invest large check sizes. We do not invest solely in a company. What we follow is a more collaborative and a consortium approach, where we kind of collaborate with our strategic customers, the innovation teams and the investment teams of our strategic customers, like a Ralph Lauren, like a Bestseller and an H&M, as well as financial investors, as you can see on the screen. We also have collaborations with industry bodies like Global Fashion Agenda, Fashion for Good, and even with the UK government. What it does for us, it gives us three advantages. First, we are able to unlock high conviction deals, as well as competitive deals, which probably we would not have access to, even with a small check size. In majority of these cases, what happens is our strategic investors, strategic customers and financial investors want us to be on the cap table. Second, for a founder of these portfolio companies, we are the preferred investor partner for them. With a 50 to 100K check size, the value through the ecosystem and network that PDS Group has, what we can unlock, is much more beneficial for them rather than a complete 1 million investment from just a financial investor. Basis where we stand and how strategic we are in terms of these investments, we are also largely able to get and negotiate better terms with our founding companies, which basically reduces the risk of our investment. In a nutshell, PDS Ventures is now seen as a validation partner for other brands and retailers, as well as financial institutional VCs to invest alongside. Also very important is the decision making. Just to give you a perception on the team, so recently we have partnered with Jared, who is from the US, who brings in a different perception and a different access for us. He has been a three-time founder, had 2 exits in the past, and he brings from the retail and technology industry, which is where the entire, I'll say, the industry trends are shifting towards. While we operate on a very lean team, we kind of leverage the internal and external network of experts in our industry as well as different functions that we have. By doing that, we believe we are able to combine the venture capital investing discipline along with a real world experience from the fashion industry. This structure gives us both efficiency and strong governance, as well as access to complete experience from the industry. The most important point is what have we achieved, or what impact strategic value has PDS Ventures added to the group. So the main proof point is on the commercial impact itself. Till date, through the relationship and the ecosystems of PDS Ventures, we have been able to create more than 100 million of potential GMV for the group. The venture relationships has strengthened the group's credibility and expanded access to leading global brands and retailers, which has helped us unlock new geographies and new segments, and also strengthened our global positioning in the industry, which has led to us unlocking many customers, as what Palak mentioned, who usually works directly with factories. To just give you an example, we work very closely with Ralph Lauren's innovation team, and they see us as a future-ready partner, value us to be a very strategic partner. Through the ventures team, we got inroads into the core supply chain teams, and that is how we were able to unlock the Central America deal with them. Similar, how we kind of work very closely with H&M Ventures, and slowly we were able to get into the entire discussions around with the H&M leadership team. So the entire angle is more about how PDS Ventures becomes the entry point of contact with all these leading brands and retailers that finally cascades at the group level. And this is the true strategic value, where PDS Ventures becomes the customer acquisition, a relationship building, and the innovation engine simultaneously. Apart from all this, obviously, we also work on a lot of relationship and ecosystem building. As an example, we partnered with Global Fashion Agenda to start the Trailblazer program, which is an open innovation program where about 150 to 200 applications across the world apply every year for an investment from PDS Ventures. The main point here is we are trying to bring the entire ecosystem together from the fashion industry in terms of the jury and evaluation of these companies, which finally get validated by brands such as Ralph Lauren, Zalando, H&M, and this year Kering also joined. And similarly with educational partners like MIT. And finally, they get kind of an investment from PDS Ventures. So it's highly validated by the industry itself. And then we are obviously we take active participation, as Palak also mentioned, at leading industry global events from Bharat Techs, which I think Sanjay mentioned, which we are doing again, in India to Best of Bangladesh, in Europe, and in other geographies as well. And all these work that we are doing is not going unnoticed. In the past few years, top journals and global publications have started recognizing the good work that PDS Ventures and PDS Group have been doing, from a Vogue business to a Forbes to business of fashion as well. And this has created visibility, relations, and long-term strategic opportunities which cannot be duplicated with traditional activities alone. Coming probably to the most interesting part, where I want to explain the entire journey and evolution of PDS Ventures. When we started in 2018, the first 2 years was more around the foundation phase, where we launched the fund, we understood the space, and initiated our strategic partnerships through the investment focus areas that we had defined. Over the next 5 years, we have been actively investing, solidified our partnerships, and grew from there. For the last 6 months now, and till now and going forward, we have entered into the monetization phase and moving towards a self-sustainability model. We have started initiating some of our prior exits, with the focus being, going forward, we'll be monetizing our prior investments that we had done, and using a portion of that to do select strategic investments along with our customers, or some of the select follow-on deals that we want to do. To give you some of those success stories of how some of those success stories have come along, how some of our portfolio is maturing going forward. When we invested in Monolith, which is an AI-powered software reducing the physical testing applicable across different sectors, we invested approximately 5 to 6 years ago at a blended valuation over 2 rounds at a 30 million. Obviously, the company went through ups and downs, but finally, after 5 years, got acquired by a US-listed entity called CoreWeave, which itself is a $55 billion market cap company. Similar example, Kavida, which was a digital supply chain twin company. We invested, we were one of the earliest investors in that, helped them build the product to an exit last year at more than roughly about 5x of the initial valuation. And that's not the end. There are more kind of companies which are maturing, and we see a potential exit going forward. So finally, I would say PDS Ventures should not be seen simply as a venture portfolio. It's a strategic platform which strengthens our customer relationships, opens new opportunities, enhances our branding, gives us access to innovation, and finally, eventually generates financial returns. The 100 million GMV that we have kind of generated for the group, plus the innovation ecosystem that we have built, along with the recognized industry leadership from our innovation partner perspective, and the portfolio which is moving into the monetization phase, gives us confidence that PDS Ventures will continue to create long-term value for the group. Thank you.
Thank you, Ankur. The next presentation is by Group CFO, Sadik Sunasara.
Thank you, Shirley. Thank you, Palak. Thank you, Ankur. Good evening, everyone. I welcome you all to PDS Investor Day, Edition 3. Today, you heard Palak, he mentioned all about where we are focusing on future, what lessons we have learned in the past, what we are trying to do, let's say, for growth, for profitability. You heard my friend Ankur, he was speaking about venture investments. You must be worried where PDS is allocating money. Rest assured, we are not allocating any new money to venture portfolio. The portfolio is in sustainability mode. They will generate returns and deploy if at all we need to deploy. So if at all, it will be a cash generating asset for PDS. Let me take you through a journey of, let's say, last 11 years of PDS. FY15 was the first year when we got listed, right? In last 11 years, if you see the left side, what we have gone through. COVID, again, nobody knew how and when it will end. Again, it passed through. COVID gave us a lot of opportunities. Industry was then going through destocking, right? There was a very weak demand from the retail. Again, we sustained that pressure. Geopolitical disruptions. If you look at the sourcing countries that we source from, or let's say you look at the Russia-Ukraine war, or even the current, what's happening in the Middle East. Two countries, Bangladesh and Sri Lanka, they had gone through challenges, right? Resulting into a lot of inflation for us. Supply chain become volatile. During all of these obstacles in last 11 years, we have expanded our sourcing network. From being a Bangladesh-centric entity from a sourcing point of view, we have diversified our sourcing network. We have invested into leadership capabilities over last 1 decade. We have built new partnerships. Again, Palak covered all of these. We are building our technology platform every year, enhancing our AI capabilities. Now, we are focused on our operating efficiencies. If you look at last 11 years, maybe 10, 11 years, we have grown at a CAGR of 12%, right? And despite all these challenges. Why am I talking about past? Because this gives a confidence that yes, even through current challenges, we'll come out, let's say, flying high. Let me not talk about the decay. Let's focus on the last cycle, which is of, let's say, 5, 6 years. Even if you look at last 6-year period, our revenue has grown at a 12% CAGR from 6,600 crore in FY20. Last year, we were at 13,000 crore. The quality of that growth is very important. We have improved our margin by 4 percentage points. So we were at 16.5% in FY20. That has grown to 20.6 last year. And we are talking about bringing more and more operating efficiencies and improving that number as well. What's more important is the EBITDA margin. So that has gone up from 2.8% to 3.9%. Again, that's after normalizing the loss from the new verticals, right? And as Palak mentioned, it's by design that we have invested into new verticals. We tried along the way few things. Some things worked out, some did not. We are course correcting, trying to put whatever, let's say, the learnings that we had, allocating or doing more and more of what is best for PDS. Let me narrow down now to last 6 to 4 quarters. So from a decade to 5, 6 years, and now what we have done in last 4 to 6 quarters. Again, I will not talk about this right side, which Palak rightly covered. So he and the business heads, the vertical CEOs, they were building the customer relationships, they were diversifying the sourcing. At the platform, Sanjay, me, we were improving our balance sheet. And I want to focus on this aspect. Thanks to our QIP, we improved our leverage. Of course, initially it was not visible because the new investments were taking away, or we were deploying, let's say, working capital for our new businesses. It was not visible. But now, if you see my last quarter results, you can see the improvement. We were improving our liquidity. Cash for me is a raw material. So if I have cash, I can negotiate better terms with my vendors. We improved that. If you look at FY26, we generated more than 600 crore cash flow from operations. Let me focus a little bit on this aspect, how we did that. We went back to our basics, let's say 18 months from today in the past. And going was very tough. We went back to our basics. We focused on customer, right? We increased our credit insurance coverage. Today, 70% of PDS's invoice value is secured by credit insurance. Another 8 to 10% we cover by way of advance or side payments, or taking LC from the customer, or some form of a guarantee. So that's 80% which is secured in our hand. The balance 20% is what we manage, and I'm sure my colleague Rajiv will cover how he managed risk with a particular customer in Germany. So my factoring ratio, which is, let's say, the percentage of sales that we put through non-recourse factoring, which was close to 42% 3 years ago, we have now enhanced that ratio to almost 55%. That has resulted in a lot of liquidity for the group. Better funding flexibility. Let me cover this point by my next slide. If you look at my total debt funding, the long-term funding is very minuscule, just less than 3%. 588 million sanctioned working capital facilities, this is a raw material for me. And again, as Palak mentioned, we are not dependent on a particular bank. The single largest bank, let's say pre-COVID year for PDS, was 55% in the overall funding. Now it has come down to less than 30% for us. In Hong Kong, we are well covered by 8 banks. So from wherever we invoice our customers, it's Hong Kong, UAE, UK, US, and a small amount from India. We have facilities in these locations. And wherever we produce, Bangladesh, Sri Lanka, that's where we have banking limits and we are well diversified. So this is what we have done in last 3 years. This has given us a solid foundation for growth in the years to come. Again, the profitability moderated during that, let's say, last 2-3 years. And again, that was by design, that we were investing into new verticals. What next? What are we doing now? Again, this slide had 3 parts. The top, we are focusing on our core, right? Palak mentioned about design-led sourcing and sourcing as a service. Over, let's say, last 3-4 years, we learned that this is what is scalable, and this is where we need to allocate time, resources, energy, everything. The middle layer is supporting the top layer, the sourcing optimization and manufacturing scale-up. We have scaled our manufacturing to the right size in Bangladesh. We have acquired a manufacturing facility in India that we are scaling up slowly. We are ensuring that the dollars that we get per garment goes up. Last 2 things, that's where we save dollars or we control dollars, right? Cost productivity. We engage with BCG. They've given us a lot of insights and learnings and their prescription. We are now formalizing or institutionalizing these learnings from BCG across PDS. My colleagues from strategy team, my colleagues from IT team, they are working on solutions in-house. They're trying to build layers on existing SAP systems within PDS, wherein all verticals of PDS can use, let's say, Coupa as a bidding platform, or whatever other learnings that BCG has given us. The last point is very important, strict investment guardrails, and hence, I mentioned that we are not allocating any money on the venture side of our business. If at all, that business or that segment will contribute to cash or profits of PDS. Again, we had already put this in public domain, I think, in our September investor update last year. At vertical level, we have put a strict discipline in terms of what they can do, they cannot do, because you would have seen many of our verticals ventured into branch portfolio. At platform level also, there is a clear public guideline in terms of what and how much money we will allocate. Let me take you to a year ahead. I'm sure most of you would have attended the edition 2 of our Investors Day. We had focused on 4 items from a finance point of view, right? Happy to inform all of you that during the last 6 or 4 quarters, we have had good results on all of them. We talked about re-strategizing our loss-making verticals and even our existing verticals a year ago. Happy to inform you that we have done that. We have cut the losses coming from the, I would say, non-performing verticals. We have put in this investment discipline by way of having investment guardrails, interest and net debt, so that savings in or reduction in leverage is now visible as we improved our working capital cycle. My factoring ratio is high now, and that is leading to a lot of cash generation and hence net debt reduction. Our interest cost, hopefully, I don't know how US economy and the Fed will behave in terms of increase in the interest rates. But hopefully, if rates don't go up further, I think our interest rate has peaked. So interest expense has peaked. Cost optimization. So this is the agenda within PDS. This is where we are focusing, that whatever learnings that we got from BCG, we need to institutionalize and ensure that all the verticals get benefit of that. This is the last point, which is New Lobster turnaround. This is one area which is still work in progress. And we are engaged with ABG, the brand owner, in terms of improving this particular subsidiary. The last slide of my presentation. GMV, we are largely on track on the 555 journey. SaaS as a business is very lumpy. As deals come in, they come in with a big GMV number, right? So as we add or announce what's there in the pipeline, I think hopefully we are largely on track in terms of achievement of our numbers. Palak covered about the scale that we have created in PDS platform, the customer entrenchment, and the global infrastructure. I'll touch upon these two last points, the cash generation. So last year, FY26, you have seen that we have improved our cash generation. We have squeezed our working capital cycle. We are not going back to, let's say, 17 days that we were having a couple of years ago. We'll try and maintain the squeezed capital cycle the way it is right now. Hopefully, the profitability is next, and it should catch up. I'll conclude my presentation here. Thank you.
Thank you, Sadik. The next presentation is by Anuj Banak, founder and CEO, Poetic Gem.
Good afternoon, friends. I hope you all can hear me. Thank you very much for coming over today and attending the Investor Day. Some of you will know me from the previous Investor Day presentation that I did a year and a half ago. And for the people who don't know me, my name is Anuj Banaik, and I'm in charge of one of the largest verticals of PDS, UK-based verticals called Poetic Gem. So I'm going to take you through the agenda for all the insightful presentations we've had from my colleagues. How does all of those presentations trickle down and translate into a subsidiary level, a subsidiary like Poetic Gem? And how we go from there is what I'm trying to explain to you in the next few slides. The agenda covers our people, our space, and our culture. We've moved into new headquarters a year and a half ago, so I'm going to be sharing a small video. Then what makes Poetic Gem unique? Category management as a growth lever, as Palak mentioned, category management in his presentation and how that translates into Poetic Gem level. Category management is nothing but an elevation from a supplier status to a partner status for a retailer. Then navigating volatility, creating opportunity. Just give you a very quick flavor of the geopolitical situation at the moment and how that is impacting or creating opportunity both ways. Then our alignment with the group on the 555 and how we see that translating into a subsidiary level where we have to keep our goals very simple. We've got to track our growth, and our focus should be on a yearly basis, on a bi-yearly basis, but ultimately aligning with the 555 strategy for the group. And then finally, a revenue snapshot and the bottom line snapshot. So I'm going to start with sharing a video of our new headquarters in Watford, just on the outskirts of London. The PDS group acquired these purpose-built premises, and we moved there a year and a half ago.
This was a major transformation for Poetic Gem, not just in terms of space, but how we work and collaborate. Partnering with area was an important decision, and their expertise made all the difference. From the beginning, this was a highly collaborative process, ensuring our employees had input into the workspace design. As Poetic Gem continues to grow, we need a workspace that evolves with us. This office does exactly that. It's built for the future, allowing us to adapt and thrive in an ever-changing industry. So our people. I think this is a very important slide where Palak mentioned of all the talented partners that have joined the PDS platform, emulating the same model on a subsidiary level. This is the talent pool that we have in Poetic Gem today. And as you can see from the slide, these people are stalwarts from their own industry, from their own retailers. And the proof of concept is very important here, that these people have chosen to join PDS, they have chosen to join Poetic Gem. And this has been a joint appointment with the retailers. The retailers have encouraged these people to join Poetic Gem and PDS. And all of these talented people have seen the Poetic Gem model. They have worked with Poetic Gem many years before selecting our company and before joining our company. So Chris, as Palak has already discussed, is a stalwart with Sainsbury's, over 25 years of experience in not only apparel, but home category as well. And then Graham is 15 years with Tesco. Arnold has just come in to look after the home division. Then we have our head of women's wear, come from Arcadia. Most of our experience spanning over about 20 years has been with Arcadia. Then we have Rahul, who looks after, and to our brands division. To Sadik's point, there have been a lot of learnings in the brands area, but brand encompasses a lot of things. It's where we have not, Poetic Gem and PDS has not been very lucky, has been brands which are licensed brands, where you have a very fat MG that you have to fulfill before you have even sold the brand. So these learnings are very important, and this vulnerability is a strength to acknowledge, yes, we've not been able to do this properly, but the brands that Poetic Gem and some of the other subsidiaries have embarked upon are brands where we hold our IPs, our own intellectual properties, where our orders are pre-sold on wholesale basis to our incumbent customers. Brands where we don't have to commit to very high MGs, but at the same time, they can yield the bottom line that we desire, and at the same time, they can give the customer an intake margin that they desire. So very talented people, also very well respected in terms of if we have to make further entries into the retail world or the e-tail world. Okay, so this slide depicts on what is the uniqueness of Poetic Gem. See, in today's unpredictable world, it's not sufficient to just keep an eye on your own business. More than that, you've got to keep an eye on your customer's business. It is extremely important that you have the right engagement with the customers and you have the right partnership with the customers. Other than creating the space where the customers come and they collaborate with us, they co-create with us, they utilize our premises in a way where they feel that, yes, this is a place where we would like to come, where their creative juices flow. They work in collaboration with our staff. So that is very important for us. And the other area where not only providing them with nice offices with a good collection, but we are a solutions provider, as Palak mentioned, a services provider who's highly flexible. Flexible to the extent where the whole geopolitical scenario, we are able to put forward solutions to a customer that are across services, across products, across geographies. It's a highly flexible model, very asset-light model. And lastly, the engagement with the customers, the concept and the proposition has to be tailor-made. We realized many years ago that a transactional relationship with a customer, like a factory relationship with a customer, or an order-to-order transactional relationship is not sufficient to scale this business. Hence, it was very important to understand from a customer's point of view of what should be our inroad into a customer and how can we have an octopus sort of an approach where you have 7 or 8 or 9 or 10 areas where you can go to the customer and you present the solutions. So whether it is a transactional order-to-order business, whether it is a design-led sourcing, or an own IP brand business, or a category management business, Poetic Gem is there, PDS is there to take care of all their needs. And if the solution provided, if the markets are volatile, then for a production-centric business or a country-centric business, geography-centric business, or a product-centric business takes a long while to adapt to the approach, but here is where we come in quite flexible. So these retail partners, the barrier to entry to start working with these partners is very high. They are all creditworthy, they are insurable customers, hence they know their market positioning as well. So you have to be a very tactical partner to be able to gain entry into these retailers. So our focus in 26, 27, as I said, we have to align with PDS's goal of 555, but as a subsidiary, it is very, very important to mark our quarterly, our half-yearly, our yearly scorecard. So these are the areas that we have earmarked to focus on, also to KPI our staff, also to KPI our customers, and in the next financial year, 1 year. So category management, which I will cover over the next slide and give you a taste of what it really means. Garment cost transparency, again, with the volatility and uncertainty and subdued demand, we cannot just look outwardly. I think it is very important to look inward of how the controls have to be there in terms of our spending on raw materials, on costing, on our efficiencies. Then digitization and AI are a given, which you cannot work without these days, because there is some disruptor around the corner who will disrupt and take your market share. Then, as Sadik mentioned, design arc consolidation that happened with Poetic Gem earlier this year. I'll take you through some of the top line points for what that collaboration meant for us and for the group. And finally, our focus for the new division, which is footwear. So category management as a growth lever. I think next is a video, probably, no, sorry. So this is a graph showing you what category management actually means. As I said, it is more of an elevation from being a supplier to a partner for a retailer. Poetic Gem identified this opportunity, and the retailers, because they've been working with us over the years, when they come to our showrooms, they realize that yes, this is the partner who we can trust, who we can partner with and give them this big chunk on our business, where we can, the retailer also can make their own business leaner. And as a trustworthy partner, they will know that yes, this company is going to be able to curate, conceptualize product, bring it to the table, bring it final logistics, delivery, and bring it to the market. So Poetic Gem is one of the leaders in the UK, even ahead of most of the big supply chain partners, where the customers are trusting us because the proof is in the delivery of the product, where you will see how the revenue scaled in just 1 year. So in August 2024, Sainsbury's, one of the mass market supermarket retailers, one of the largest retailers in UK, we've been working with for over 20 years now, spotted an opportunity that yes, there is an activewear opportunity. Activewear is a huge category even in India now as the West. They saw the range they wanted with co-creation, with working along with Sainsbury's design and buying partners. We came up with a final range and we launched the range in September 24. So what we offered to Sainsbury's was something that we were not doing earlier, where we have a PR department within Poetic Gem who's able to offer forward integration to celebrity endorsements, because Reactive is one of our own brands. It's Poetic Gem brand IP. So we were able to attach a celebrity, we were able to attach influencer to the brand and also manage the influencer. Earlier, the model was for retailers to manage the influencer or the celebrity contracts. It's a very cumbersome part of their business, and they would rather give it to a trustworthy supplier. So we did that. We did end-to-end management of this brand, and we launched in September 24. And they started with about, I think, 50 stores. And then by Jan 25, they took it up to 100 stores only because of the proof in the pudding. The sales were 5x, much more than what the planned sales were by the Sainsbury's merchandisers. In 1 year, from September 24 to September 25, our revenue to them grew to 15 million. So which roughly means in retail, the activewear proposition that Sainsbury's took to market, took to their customers, was almost to the tune of around 25 million to 30 million. That's the retail value for the brand. So they were recognized in some PR and also in the press. And seeing the success and the growth of this brand, in January 26, they have now extended this to menswear as well. And in August 26, they are launching kidswear. So this, in a nutshell, is managing an end-to-end category for a customer. And they know that it's a Poetic Gem brand, but still they have the confidence of putting it on the shop floor, putting it on the mat with their own brand, with their own private label, only because of the fact that this enhances their revenue multiple times in comparison to their own brand, which is 2TU brand, which you will see in the next video. So that was a short video for what the PR has created that goes on a lot of media channels, goes on top of some of the buses in London. If you are there, you will see. So huge coverage we get from this. And this is, as I said, this is our brand, our own IP. So the value creation is in our brand, not in the Sainsbury's brand. So if tomorrow we are not selling this to Sainsbury's, it's got the valuation, we can take it anywhere we need to. some press coverage that our brands get in very popular channels within the UK and Europe. So some of the brands that you saw in this video were our own IPs, and some brands were licensed brands. But as I mentioned before, whilst selecting a licensed brands, we have learned it the hard way. We are very, very careful in terms of the MGs that we are committing, preempting a P&L before we have committed to an MG. So we know the distribution, we know the annual revenues for the brand. So the next slide is a very important slide, which the previous speakers have touched on. But I just want to show how this interprets at a level where we operate, and we see this on a daily basis. You know, the headwinds, as we see, you know, in today's scenario, there is such a major squeeze on a consumer's wallet that buying apparel from these retailers or e-tailers almost becomes like a last priority by the time they've filled their cars, or they've paid for their energy bills, or they've paid you know, for their food bills, or they have paid the rising mortgages going up due to the interest rates going up in the West. So how do we look to mitigate these kind of circumstances? We engaged 2 years ago. PDS engaged BCG to look into some of the top 3 verticals of PDS and take a deep dive into our processes, into our systems, and on the basis of that, advise what our next step should be to prune the tree to be able to, because we are in a high-cost location, we needed to you know, see how we could probably be aligned in terms of what the margin requirements are for our business as well as for the retailer business. So the top 3 headwinds in terms of subdued consumer demand because of pressures on the wallet, rising supply chain costs as a result of various things going up, you know, like raw materials, fuel, margin pressures, and price sensitivity. So margin, in spite of the fact that costs for the apparel probably is going up, the retailers are under pressure to keep their retail prices low, to keep the retail prices stable, if not lower. Hence, BCG took a deep dive into, you know, how we cost a garment. And there were a lot of gaps in the Poetic Gem costing model in terms of we were doing a costing for the garment, but we were probably doing a little bit of a superficial costing for a garment. You know, they came and they introduced a very modular, a very granular costing sheet, which our teams are now following religiously, and they cannot, it is linked to our SAP system. Unless a BCG costing to that forensic level, to that granular level gets filled, the product does not go to the next stage on SAP. So that has brought about certain savings in the system. The other suggestion from BCG, which has been a game changer for us, is a very cliche suggestion, but we were not following religiously within our system, which is a bidding platform called Coupa. So all our teams now, all of the PG teams, all of the PG verticals, it's become mandatory for everyone quoting a price to the customer or ordering fabrics and trims with the suppliers to go on the Coupa bidding platform to invite their own suppliers they've been dealing with, also deal with the PDS central teams who bring in fabric and trim suppliers. So we do a very considerate, a very concise collection of the suppliers that come on the platform, and then we have a bidding process. We have a very, very frequent bidding process. We do not have a quarterly or a bi-yearly or a yearly bidding process. So We go on the bidding platform, we bid monthly, and we allocate programs, keeping in mind who the L1, who the lowest supplier is, but also keeping in mind that those suppliers have performed for us. And then digitization and AI had cut cost and speeding things up for us. I think there's another video, looks like.
So we've been trialing out the new AI platform, and it's just been amazing in our whole creative process.
It is brilliant at being able to create things quickly and ideate quickly.
Visualize really quickly, yes. And it's great sending ideas across to our buyers, and because it is time saver.
But also in terms of not having to sample nearly as many products, just because the 3D renderings are so realistic.
So for example, a buyer might ring up and say, oh, that t-shirt's not quite what I wanted it to be a bit more girly. And instead of having to rack your brain and think, well, how can I make it more girly? You can just put it into format, it will spit out 5 options, and then send it to the buyer and get a quick steer on the one that's wanted, and then that can then be worked up properly.
We've been utilizing it for advertising and campaign shoots and videos, which is really so cool to be able to see your garments in an ad-style campaign.
Yeah, it's really helpful.
So for the teams, I would say it just enables them to get back on things a lot quicker. Turnarounds can be days rather than a week, week and a half. And it does take a lot of the grunt work out of simple things like tweaks to old styles and things like that. It just does it all really quickly, and thereby ultimately probably reducing the amount of manpower that you will need to have to deliver these things.
Using AI has really transformed our whole design process.
It's helped us with our creativity and our efficiency.
It means that I can ideate anything I want really quickly. So all of that then maybe reduces the necessity to do quite so much sampling.
The benefit of Coupa bidding, the process we have introduced, where we are bidding for fabrics and trims across a vendor base to get the best pricing out of them. With this process, we managed to get a 30% saving on a polyester fabric, sportswear fabric out of China, which in the current worldwide conditions is an achievement for us and something that we need to continue doing across all volume lines, be it fabric or trims. So rather than going to new people and asking for prices without seeing qualities, without them engaging with us on product development, we were able to get a better price from existing mills, which is a big achievement, I feel, for all of us in the business.
So I'll quickly touch on the next couple of slides. We're running late, I think. So Poetic Gym and DesignArc. DesignArc is another PDS subsidiary, where there was a question asked earlier before the presentations began. So rather than optimizing a smaller business unit within the PDS group, we saw that it was better to probably merge it with a larger subsidiary and create an ecosystem which was much larger, and we would be able to make a scalable proposition even for the customer, for which the competitors will not be able to match. So we just did just that, and we created a much larger ecosystem. And now, with the combined forces, with the teams, we were able to do a major cost saving between the two businesses. We were able to make the businesses leaner. We were able to combine the infrastructure and get the shared value out of the infrastructure, enhance design and sourcing. So footwear and accessories is our focus for this year, whereby Arnold, as you saw, joined the business. 15 years, 20 years with CNA footwear experience, has already started this business last year, supplying into retailers like River Island, Ted Baker, Fraser's, Max, and Very. So this is going to be our focus category, where Poetic Gem has always, the last so many years, focused only on apparel. but this will be another category we will be looking into seriously, doing some category management business. So my final slide is the revenue, which combines the Poetic Gem revenue and the GMV for one of the SaaS verticals. You can see the graph of how the revenue has scaled. FY26 is also because of the merger of DesignArc entity with us. And without a mention for PBT numbers, what you have seen, what Sanjay has put forward is our bottom line was 3%. What we have tasked our business, what we have tasked our teams to be at least 4 or between 4 and 5% bottom line for this coming year. So I think this will be covered in more detail. So that's about it. Thank you very much, guys. Thank you.
Thank you, Anuj. The next presentation is by Rajiv Ranjan from Techno Design.
Good afternoon, everyone. I'm Rajiv Ranjan, founder and managing director of Techno Design based out of Germany, Düsseldorf. Techno Design was founded in 2014 in Düsseldorf as a joint venture between PDS and my company. What do? We provide, it's quite obstructing when it comes to there. We provide end-to-end sourcing solutions for leading brand and retailers. And over the last 12 years, we have evolved as one of the leading players in the German fashion market for sourcing solutions. We support our brands and retailers to simplify supply chain across product design, sourcing execution, and inventory management. And how we do is by using our global multi-country sourcing network across Bangladesh, India, China, Pakistan, Turkey, and some of the other Middle East countries. The environment which we are dealing in, and all of you are aware what's happening in the European market, the German brands and retailers all are under increasing pressure. In 2022, Ukraine war started. That led to very high energy costs for the German industries. Further to this, the Iran war has worsened the situation further. What is leading to is high cost for the industries and job losses across all the industries, including automotive industries. Now, that trend is leading to a very strong pressure on the consumers also, because the consumers also have to pay very high energy costs. And at the same time, there is an insecurity regarding jobs. So there is a weak consumer sentiment. There is an inflation pressure in the market. Consumers, and Anuj talked about it, consumers are spending less and less money on the fashion and lifestyle. The problem gets further complicated because players like Shine and Temu have an playing field advantage. They are using the loophole of custom and duties and compliance regulations and bringing cheaper goods into our market. Currently, EU has recognized that and they have taken some steps, but in our perception, these steps are far too little to dampen this unethical competition which the German brands and retailers are facing. So there's a large pressure on the brands and retailers, on the one side, on the margins, on the other side, on the costs, as the costs are increasing, profitability is going down, and there are many brands and retailers under serious financial pressure, and partly also getting into very distressed situations. So in this very difficult market in which we are currently into, we have created our value proposition as a strategic supply chain partner. Palak talked about it, the various measures we take. First, we have focused on how can we support the brands and retailers in their improving their price-value equation. For that, we use our global sourcing network. We use our scale to provide them with better prices so that they are able to offer better prices to their consumers, but also they are able to improve their margins. Second piece is, while they use our sourcing structures, they are able to reduce their overheads, so the cost. On the one side, in the countries where they have their offices, they're often outsourcing these offices to us. And the second piece is that they're able to reduce their manpower in the head office. The third pillar is the working capital support. We support the brands and the retailers and even the factories with working capital. However, we make sure that these financial instruments are completely secured. And later on in the slide, I'll show you a bit more on how we did with a particular brand. And the fourth pillar is value-added services. When we talk about value-added services, we have been one of the very early starters of the 3D. We started with 2020. That reduces their cost in terms of sampling and sales samples. We managed a lot for some of the brands and retailers, the never out of stock program. That means we manage their inventory. And now we are using AI to support their inventory management, which further reduces their allocation risks and rebuy risks. Now, through our value proposition and being a strategic partner and strategic collaborator with many of the companies, we took over in 2019 the business of NKD for India and Pakistan. So we took over their office, and in turn we got a 5-year exclusive supply chain contract. Even today we continue to be exclusive partners for them in home and hard goods in Pakistan and non-exclusive partner in India, though we are increasing the category now with the apparel. In 2019, later that year, we took over the office of KIK, which is approximately 3 billion size retailer, and we took over their office in Bangladesh and got a contract, agency contract, and we continue to do business even today with them. In same year, Metro, which has been one of the leading food retailer, decided to outsource their textile business, apparel business, as they wanted to exit out of apparel business after 5 years. There was a 5-year fixed contract. In fact, it ran for 6 years as they had to delay the exit of the textile business. In 2021, we took over S. Oliver's office in India, and we had an exclusive supply contract for 3 years from India and Sri Lanka. That contract is finishing this year. It was further prolonged by them, but we remain a vendor to them. In 2023, we took over Gary Weber's global sourcing operations, and all these strategic collaborations, all these efforts which we put through our value proposition led our company to grow by 2025 in the last 5 years by 2x. We had a CAGR of 18%. And through this growth, we delivered consistently a profit between 3.5 and 5.5% before taxes. However, our takeover of Gary Weber, which was in 2023, which delivered them a bottom line of 10 million. And this bottom line was done by the 3 instruments I talked about in terms of cost reduction, better pricing, better margin, and also the working capital support. Now, this structuring, what we did with Gary Weber, also brought another strategic benefits to our company. It strengthened our footprint in the premium segment, which was before that not our strength. It also, our sourcing landscape further extended toward Africa and Turkey. So we started further production in Albania, Turkey, Morocco, and Egypt. And it set up a foundation for such future such takeovers because it brought also a lot of reputation in the market. And all these efforts also financially brought benefits to us. On the one side, we delivered them 10 million profitability. On the other side, our company was also net cash positive. Unfortunately, in 2025, in March 2025, after running the operations for 2 years, Gary Weber had to go through insolvency process. And our personal perception is that there have been many management mistakes. But how did we secure our credits and our WIP? And that's a very important piece. Palak talked about that. We always work with very clear, secured credits. So the commercial contract had 3 clear points. First was that to avoid any early insolvency, we had, for the first 6 months, a $2 million escrow account, so that in case of insolvency, we don't sit with the cost which we had taken over their offices. After the 6 months, the escrow account was no more needed. The second piece was that we were secured on all the 100% account receivables. We secured through taking the securities of all the brands and inventory. And the third piece was that for the WIP and the goods in transit, we had the brand rights to sell the brand in the core market. Now, it led to the situation that we were paid 100%, all the goods in the pipeline, and in transition were taken over. There were about $17 million worth of goods, were taken over by the administrator at the full price, and in fact, we were paid for any delayed payment, all the interest costs. So probably it was first time in the history of Germany retail that no factory lost a single cent in the process. And I think this is because of the commercially excellent contract which we have been able to do. So though we did not lose any credits, any WIPs, of course, we lost revenue of $80 million. and that has been very challenging. As an agile company, we immediately went into a proactive cost restructuring. We set up a project called Phoenix. This project was based on 4 key guiding principles. One was to protect our people and culture. We had to make sure that the team which was needed for the future business and all the critical talent remain in the company. The morale of the team members was not lost. Second piece was what we should deliver, what we can control. That means to make sure that operationally we were delivering everything what was in the pipeline. Thirdly, we worked to reduce our fixed cost, reduce our overheads, and we managed this with a proper fiscal discipline. Finally, we were able to save cost of 3.1 million through this process. And we have been, in spite of losing 80 million worth of revenue, the company remained profitable. Though there has been a meltdown of profit, the company remained profitable. Now, after the restructuring, we started working on the path of growth because we wanted to come back where we were before Gary Weber. The one aspect was the geographical mitigation. We talked about the difficult German market, the difficult situation where the German economy is today, and we do not expect a very quick recovery as things stand today. So we looked at the neighborhood, and Poland, which is growing, as you see, by 3.8%. Switzerland, though a smaller country, has been reasonably resilient, has been also growing at 1.3%. So we started working on those customers. We started keeping our focus on the premium segment. With the support of, or with the takeover of Gary Weber, we have been able to build up capabilities in our sourcing market as well as in product development on premium market where there is a high margin. So we kept the focus there. And of course, we decided to keep expanding our core business, which was value business, and also the home and hard goods, which we had started. And I'm very happy to say that we have been able to 3 large customers, Mikasa, which is a Swiss furniture and home decor retailer, we have signed a contract with them for 10 million exclusive business on all home textile and hard goods. This contract has been signed. We have also a credit insurance on that, potentially 10 million. Already this year, we're expecting about 8 million. Secondly, with the support of PDS, we have been able to onboard in Poland CCC half price, potentially 30 million business. First full year is this, where we are already doing over $15 million business. And thirdly, TCP and Jimbori, which is a kids wear specialist. Current year is expected about 10 million, but potentially another 30 million. With this growth strategy, but also based on the key drivers, we talked about the new strategy account wins, premium customer onboarding, but also creating new product and services through AI, something like test and repeat, where we are able to test a product and deliver it very fast. On these 3 pillars, and productivity enhancement, which is supported by the AI as to how we can be more efficient, we are expecting to grow again by 18%, and in next 3 years, grow to 1.5x, and having a profitability around 3.5% to 4%, which has been also there in the past. So I hope with this, rather I'm confident that with this, Techno Design will be a good and great strategic partner for German fashion brands and retailers. We represent a resilient platform, And for our investors, we are business ready for profitable growth. Thank you very much.
Thank you, Raji. Next presentation is by Michael Lee, CEO, GSC Links.
Good afternoon, everyone. Firstly, I'd like to thank you, everyone. I know we're running a bit late, so I'll try to be really concise and keep this to 15 minutes. So it's a privilege today to have an opportunity to talk about my journey in terms of joining PDS, and also to share with you the overall US market. So maybe before I start, just a quick introduction, because I haven't met many of you. This is my first time joining this Investor Day. I've been in the apparel industry for over 30 years. I started actually in the IT sector as a programmer, in fact. But I joined the sector as a CIO, and then I moved on to operation with a large apparel company called Esquel Group. Then I had the privilege to join Liz Claiborne when they had a lot of brands. I was their head of sourcing there. Went back to technology at Accenture and was an MD at Accenture, ran their retail practice for Asia. And then I joined Gap for 9 years, running their sourcing business across all the brands. And I had the opportunity to run their retail business in China. And lastly, I joined MGF, which is part of mass industry, as a CEO. And then I went to my entrepreneurial journey, which I've been privileged to being able to have the opportunity to join Palak and the PDS family. So on that, let me talk a little bit about how the journey was and how I got here as one of the new verticals that Palak was talking about in terms of the investment. I started my own company about 2 years ago. Last year, when I met Palak, I decided the company, in terms of what PDS and the entrepreneurial spirit, was the right company for myself. So we decided to merge the company with PDS North America, which is one of the subsidiaries within the PDS family. At that time, PDS North America did not have, in terms of contracts signed and so forth, so we've had a lot of growth in that area, but we merged some of the team and resources into what I'm going to share today. Wanted to also talk about why I joined PDS and why I decided to join the PDS family. I was previously very much close to the Li and Feng family. Victor and myself are good friends. We actually, when I left Gap, the reason I left Gap was that there was a conversation about Li and Feng buying out Gap China as a licensed partner, and so forth. I'm also was part of the board in terms of Li and Feng Toys R Us business and so forth. However, saying that, I felt like when I first met Palak, the whole conversation about PDS being a real flat organization was very appealing to me, and the fact that PDS had an entrepreneurial spirit where every founder and CEO runs the company. That was very interesting to me. So I decided last year in May to enter the journey. And August, we decided to form the new company. So my company and PDS North America merged together, and we formed a company called Global Supply Chain Link. And I'll talk a little bit why I decided to use that name. Global Supply Chain Link, global meaning we're totally global, and you'll see all the offices that we have. Link meaning we're linked to the vendors. So that was the hypothesis that I had in terms of the company and the services we can provide to the US market. So we have very strategic partnerships with our vendors. Some of them we even have some shares with some of these big state-owned Chinese vendors. And then we also have some brands. The brands are actually not part of the PDS company, but they're brands that I had in China. And we decided to put them there because we try to tell our customers that we understand also the brand side of the business. So that's the formation and journey we had from last year. Now, I'm pleased to say and share that within a very, very short time, which is less than a year, we've been able to open a lot of accounts, both in terms of areas that are more traditional, like the FOB, DDP, some of the businesses and the manufacturing partnerships on your left-hand side there. And then we also have strategic sourcing as a service contracts with players such as Ralph Lauren for the US, for the Central America market, as well as one of the larger discounters, $14 billion discounters, off-price retailers called Family Dollar. So I'll talk a little bit about it a bit later on. So we're very excited about this, very, very short and very fast in terms of this track we've made. So let me kind of switch a little bit and talk about some of the observations I have, talking to other people, seeing the market, understanding the market. I've spent all my career in the U.S. and want to share with you some of my views in terms of what we're seeing in the U.S. market. So these are the 5 points that I want to share from retail consolidation. On the supply chain side, I'm not going to talk too much because my colleagues already talked about the difficulties in supply chain and cost rising and so forth and so forth. But let me focus on the U.S. Retail market. One, there's definitely a brand acquisition. Many brands are having trouble. They're challenged, and they're being acquired by what we would call some of these PE consolidators, right? And the PE consolidators, what they would do is buy the brands and then license it out to other players, which I'll share. And these players, which are generally the importers, large importers such as Americo, have grown very, very fast. So their whole model is, as these brands get acquired, they get licensed, and the licensees sell it to the department stores or the hypermarkets or the discounters. So that's one of the things that's happening in a very quick way. The other one, the clear winners in the market is the off-price players. We see that continuously, and it's almost like gaining momentum. So you look at TJ Maxx, they have a 6% growth. Burlington, very much similar. Ross stores, all these people are, and Family Dollars even, I would add, they all are kind of now growing in terms of both revenue, and profitability continues to be very healthy. The third area that we're seeing is on the direct-to-consumer and the specialty retailers, which are retailers and brands that have stores. That's what we call special retailers. These guys some are winning, some are losing. The winners are, as we can see lately, it's A&F in the special retail space. American Eagle is also winning. Gap is coming back. They're kind of now positive comping. And then we have many that are losing. And some of these, and the main thing that drives that is that people are not shopping in malls and so forth. So having stores is not necessarily like the old days. There's an advantage and opportunity. The fourth area is department stores continue to be consolidating. So we see winners and losers here. Macy, for example, they've been continuously restructuring it in their businesses since the last 6 years, closed many of their stores, focusing on more now online business and so forth. And the jury is still out if these guys are going to be succeeding or not succeeding. And the other department stores are also going through a lot of consolidations and changes and cutting the stores. Kohl's had seeing some momentum that we're also seeing in Kohl's as an example. Lastly, I would say that this whole market, from a wholesale perspective, we're seeing is some wholesalers are winning greatly if they have a really great brand entity and equity, such as Ralph Lauren. But many are finding it very difficult because the channels are getting less and less to sell to. So, for example, you got Nike, who still has a significant reduction in their business. They're trying to sell it to many of the large retailers that are some of them are doing well and some are not doing well. So these are all some of the factors that are happening. Many changes in the U.S. market, but saying that, the overall U.S. market is still growing. They're one of the few places in the world where there's still a 3% growth, and it's a $350 billion retail market. So it's a market that we at PDS we are fully aware that there's a lot of growth opportunity, but also a market that we need to be in there. But it's definitely a very volatile market right now. Now, on the consolidators and the licensing-led brand model, these are the three bigger players that are currently continuing to acquire brands and continue to license these brands out to importers, licensees, whatever you want to call them. We see that continually building momentum. We foresee some of the brands in the U.S. Will have some difficulty, and these companies will continue to be picked up by some of these guys or others, like Blue Alliances and others. Authentic Brand Group, the brands they picked up are some of these we're working with, and as all of you know, PDS has a very strong relationship with Authentic Brand Group. WHP Group, again, they just picked up Marc Jacobs, and they continue to pick up momentum in terms of some of these brands. And then G3 also just recently picked up DKNY and so forth. G3 picked up Marc Jacobs. So that will continue to change and continue to evolve in terms of these consolidators. We also foresee others coming into the market. There is definitely interest from some of the Chinese equity players coming into the market at this point. However, saying that, I think some of these traditional consolidators and license and brand owners and licensed business model continue to have a lot of momentum as well as relationship with some of these the brands. So that's kind of what's happening in the overall U.S. market, I would say. I would summarize by saying it's growing. It continues to be a huge market, but a lot going on in terms of brands that are either suffering and consolidating, players that are surviving, some are not surviving, retailers, department stores that are have to make a lot of changes, but at the same time, we see a huge opportunity and huge growth in the off-price sector. So how do we in GSCL play in this market as well as the other PDS companies? So I want to talk a little bit about that and some of the capabilities we have that allows us to, we think and believe, will win in the U.S. market. So firstly, it all starts with people. I would say the most important thing is, as Palak talked about, many the previous our colleagues also, previous presenters also talked about, the team and people are the most critical. So within our vertical, I'm very pleased to say that we've been also be able to attract many individuals to join our company in a startup, really, in a real startup. And just an example of some of the individuals that have joined GSCL in the past year, just to go through. For example, Sanjaya. Sanjaya was an ex-president at Brandex. He was a CEO at Hella. He joined us to lead the U.S. business. Lovshan was in MGF, also actually joined Li & Fung, was in Li & Fung for a period of time, short period of time. He also joined us, and others here. Andres has worked with me at Gap, now handles the Ralph Lauren business that's sourcing the service, and we could not have got that contract, honestly, without someone like Andre's capability running Central America. We had a very lean team in Central America that we could not have given Ralph the confidence to give it to us if it wasn't for Andres as a good example. The other areas that I'll talk a little bit about is that our business is very category focused. We're focused on intimate, active, and denim. And Eva is one of the strongest young talent in a company called Clover, which if you're in the active business is one of the leading companies in intimate. So she joined us based in Hong Kong and helped us to really establish and grow that intimate and active business. These are some of the product categories that I talked about that we are in. Let me just quickly kind of go through a little bit more on the operating model that we have. Our business is focused on strong product category focus first. So intimate performance theme is our core kind of area that we grew and started out our business, and also on the denim side. So I would say those two categories is our foundation. We've obviously, as we get other businesses, as customers know us and see that we provide value, they will get us involved in other categories. However, saying that, we go in with a very strong focus that we are strong in these categories and we have experts in these categories, as well as experts with vendors that work with us. So that's kind of our big, and we started the investment by investing in these product categories and in product development and design. So I'll kind of briefly talk about it. On the design side, we have a studio in New York. We invested on a lab, a denim lab in LA, and we also have capability in terms of Sri Lanka with our innovation sample room. We obviously provide vendor management services, and in terms of we do sourcing as service, but also LDP and DDP. So that's our business model. I mean, it's simple, but it's all based on great people and investment in product development and design. Now, this is the area I wanted a little bit maybe to touch on a bit more than the other areas maybe in the 15 minutes that I do have, is as we talked about the changes that's happening in the U.S. market, we feel in GSCL, we're in a very good position in terms of the customers that we were able to bring in the past, I would say 10 months, it's less than even a year. On the department store area, our key customers is Walmart, Kohl's, TJ Maxx, and Family Dollar. I would say it's actually department store and even the off-price channel. These are, as we know, the winners that we feel are going to be involved in the future. Walmart, we currently work with Walmart in their private label program. So we are a direct vendor at Walmart. We supply design services to Free Assembly and Scoop, which is their elevator brand. It's where Walmart, the new Walmart stores are really investing in. They put it, if you go to the new Walmart store, you'll see it in the front. It's where they're putting resource investment. We are the key strategic vendor in the denim space for these private label brands for Walmart. So we know and sit with all the senior level people in Walmart, USA, talk about how we can help them in Walmart. Kohl's, we've been fortunate to be the first vendor and partner to open up Egypt and Africa as a partner, over Li & Fung, to be honest, and then that's a very key relationship. And Kohl's, as some of you have seen, their last quarters, their business has been getting better and better. Again, we do their private label for them, the business in the denim sector. TJ Maxx, we're very excited. We've been elected as the first intimate brand private label partner. So we are working with them to develop private label business for an off-price seller, which is very new to them. Traditionally, the off-price guys, they tend to just buy off-price or items that are left over from inventory. But this is the first time they're launching and piloting intimate brand in TJ Maxx. So if you go to the store in the U.S., any of you maybe, hopefully, maybe some of you maybe get a chance to go. If you go to the store, you'll see it in July. That'll be the first TJ Maxx own private label intimate brand that we're pushing. So we have huge hopes on that. Family Dollar is a $14 billion discounter, kind of mostly selling non-apparel. We won the RFP against Li & Fung for apparel. So that is a 3-year contract with, as of now, $40 million contract for 3 years FOB. We had a great meeting. They want to grow us to 80 million, and they want us to hopefully help them in the non-apparel area too. Li & Fung did non-apparel, but we're doing the apparel side, so we're very proud of that. On the brand side, again, like Palak said, most brands, they want to go direct to factories. That's just how brands are. Coming from Gap, we won't even look at a company that is a company like ourselves. They traditionally always want to go direct. In this case, we're very proud to open up some of these brands because they feel that we have the people, the vendors, and the capability. So some of the brands that we opened up, PVH with Calvin Klein, we are the first brand that Calvin is working where our model is based on a low asset model without no factories. So we open that up, and then we have a lot of these athletic brands that we're working on that they are bringing in, such as Canterbury, Berghaus, and Speedo, and so forth. So on the brand side, and they picked us because of our active and intimate kind of capability. So our strategy, I feel, is working. These brands are very, very difficult to bring in terms of us being a vendor, but they see value in us both in terms of either category expertise or certain expertise or country expertise like Ralph Lauren, where we are strong in Central America, and so forth. And then the last space, which is we're very, very excited, direct-to-consumer in the US will keep on growing. We feel that we are set up and we want to grow that sector. It's a very different sector to manage, but we're focusing on that, and we're seeing a lot of growth in there. And most of these are all Hatch, Hoo-Ha, Epperjay, Pepper. They're all intimate brands in that D2C space, and 10,000 is an active brand in that space. So our strategy is very focused, again, very focused on category, focused on these areas. So based on all the changes that we are seeing in the US, we feel that we are very well positioned. We're positioned well for the department stores, like we talked about, which are and off-price guys who are winning. So we're there. We also are positioned on a direct-to-consumer side, which we talked about, that's growing in the U.S. That we also are there. And on the brand side, we are conscious about picking brands that we think are that can help us or can win. This is just kind of talked about again. We're a global company from a perspective of having offices across the region. That is critical for the U.S. market. We've frankly piggybacked over the tariff situation. So Mr. Trump actually has helped us because as people go out of China, needing to go out of China, looking at different options, having different offices and factories has helped us in terms of a value proposition. Secondly, like I said, we have these product development investments, which also differentiates us with some of our competitors. This is just this example of a picture. I don't have the fancy video, sorry, I apologize. I'll have it next year. We're still a startup, but at this point, I just want to show you on the intimate and active. We have a facility there in Sri Lanka. We have a sample room. It's been one of the areas that brands have really believed why we can add value and what differentiates us from others, because we actually are investing on design, product development, sample room. They own the innovation in this case, right? They do the development in sample rooms, so they own it. The brands own it, not the vendors. But we're open in terms of working with the vendors. We also have a partnership with a denim wash house in LA, which is very unique. It's again another area that differentiates us from others. We have a program with Walmart right now in terms of another company looking at Made in USA and so we're very excited about that. On that, we believe that's an important area of differentiation, and this wash house facility kind of puts a stamp in terms of our investment as well as our capability in the U.S. and Central America region. And again, this just shows you that we can do end-to-end. We go from a design to wash to fabric and so forth. And these investments are the prime reasons we've been able to get a lot of traction in a very, very short time in the customers that you just seen. This is a little bit about a forecast, right? So again, this is less than a year. So we're very pleased with and very excited about the customers we brought in and some of the GMV and some of the revenues. As all of you know, the revenues unfortunately don't come in until we actually ship out, the way that's how our revenue basis works, right? And within a very short time, we've been able to, most importantly, we feel some iconic customers in our business, and some of that opportunity will come in and scale will come in the next couple of years. So we have a very healthy pipeline for the next 2 years in terms of growth, and foresee ourselves at this point, honestly, consolidating our business with the customers we have and going a bit deeper with them in each of the cases. And so that's kind of thank you again for listening to a very short presentation. Maybe I gave some time back to some of the others, so thank you. Very.
Thank you, Michael. The next presentation is by Abhishek Nawani, CEO Manufacturing. This is the last session. After this, we will have the Q&A session.
Good evening, everyone. Am I audible? All good? So good evening, everyone. My name is Abhishek, and I represent the PDS Manufacturing for the group. So before I begin, I would like to thank the organizers for placing me at the very end of the session. This gives me an opportunity to steal some more minutes from all of you and also not worry about the next presenter in the line. I'm here to talk about manufacturing, which is not really the most glamorous part of our apparel business. It's the engine room where things get done and which keeps things moving. And I can tell you that this engine room or this manufacturing is going to be the most exciting stories of growth in PDS. So this slide basically tells us what we have built so far. And I can tell you that the most interesting stories in business are not often the loudest ones. While most of the industry was talking about supply chain diversification and the future of global manufacturing, PDS was focused on preparation, investing in capabilities, advancing our capacities and improving our operations, and making strategic acquisitions, and of course, strengthening our leadership. What you are seeing today is nearly a decade of disciplined execution and tremendous efforts from our teams. What started 10 years ago as a support infrastructure for our design-led sourcing business is today a standalone value creator in its own right with strong global ambitions. We are here today with 14 factories and a 62 million pieces annual capacity. So taking inspiration of PDS's design-led sourcing, and my senior colleagues, Anuj and Rajiv, spoken about it, and they being the pioneers in this, we are taking our manufacturing to the next level. We are going to be a design and product-led manufacturing. And for this initiative, we have set up a design and sales hub in the UK, a design team in Gurgaon, which is going to be tech and AI-driven. And we also are setting up product development at the factory level. Now, I would like to proudly present I don't have videos, but I have some beautiful pictures to show you at what we've been able to build in the PDS manufacturing. So Knit Gallery is our latest acquisition and a strategically important addition to our portfolio. Apart from an additional 40 million capacity in the business, this also brings world-class manufacturing capabilities and a proven track record in children's wear, intimate apparel, and nightwear. These are the three fastest growing categories. And leveraging the core strengths, we also see significant opportunities to expand into athleisure and adjacent knitwear categories. As you know, that athleisure is the fastest growing segment in the garment industry today. Knit Gallery should play a pivotal role in our India growth initiatives and long-term value creation strategy. This beautiful factory that you see is Good Earth Apparels in Bangladesh. It's a center of excellence for women's tops, dresses, and men's shirts, all kind of shirts, with strong product capabilities and a commitment to sustainable manufacturing. Today, approximately 70% of the factory's energy requirements are met through solar power, and we are actively working towards making it 100%. At the same time, we continue to optimize our operations, invest in advanced automation, to enhance productivity and improve efficiency. This shall separate us from the rest of the competition in Bangladesh. The name of this factory is Progress Apparels, also based in Dhaka. This is our second state-of-the-art manufacturing plant with unique versatility across bottoms category. From tailored formal trousers to denim, this facility provides our customers with a comprehensive one-stop bottoms manufacturing solution. Building on these capabilities, we plan to further broaden the product portfolio by expanding into additional fabrications and construction techniques. This shall further strengthen our value proposition and deepen customer partnerships. So this slide provides you a snapshot of what product we produce in all the 3 factories. As you can see, we are very versatile when it comes to the product, and we supply to some of the most well-known and reputed US, Europe, and UK retailers and wholesalers. And our current efforts are to go up a notch and get into more co-creation and product that we will be creating or designing for the customers based on their brand DNA and offering it to them at a slightly better pricing. And this is all that we can onboard better customers, increase our profitability with the existing existing buyers, because we don't want to be just a tech pack converter. We want to be a design-led manufacturing that comes up with its own designs, and we have studied the customer's DNA, and we're going to design into it, and we offer our own product which the customers would happily adopt. Before discussing where we are going, I think it's important to appreciate how far we have come. Our manufacturing business started as a strategic extension of our sourcing platform. In 2017, when we started with an INR 4 crore of revenue and operated at an EBIT loss of 11 crores. Gradually, we started focusing on operational turnaround. We strengthened factory operations and built a stronger execution culture. We increased the revenue to 71 times to INR 285 crores in 2021. That was the first turnaround. We significantly expanded our manufacturing footprint in India through the Knit Gallery acquisition. As we stand today, we have reached a turnover of 1,000 crores with 5% EBIT. Our journey ahead. So this is where we see preparation meeting opportunity. For the first time in many years, the industry tailwinds, government policies, and our own capabilities are all aligning in a very powerful way. Global sourcing patterns are evolving, as my colleagues have spoken about. Customers increasingly diversifying the supply chains, the China +1 strategy, the Bangladesh +1 strategy, and with India signing the UK and Europe duty-free agreements, India's role in the global manufacturing is going to only strengthen from here. So I would say India is the next big thing, or in fact has already arrived when it comes to the one-stop solution for global manufacturing, where the customers want to move the product into India. But more importantly, it also has a very big domestic market to cater to. And as the India domestic market, as it evolves and becomes more sophisticated, there will be a huge requirement of manufacturing that will be required. And that's where we come in. As a company, we strategized, we've decided that we are going to support the Indian consumers' requirements when it comes to mass market and also aspirational products. And all this is only possible from the base of this is all PDS Edge, because PDS is a global platform. They've always had a very strong design-led sourcing. They've had customer relationships for years, and manufacturing has been able to leverage that very easily. And that's the reason you see today with 10 years, we've been able to achieve a lot. And I think our journey ahead is far more exciting. These are the key focus areas, but I want to talk about little more. No apparel company, if it doesn't think differently and evolve continuously, will never do well. Apparel business has become very, very challenging. What it was in the 90s or 80s or even 2000 is very different today. And as PDS manufacturing, we are going to continue to reinvent ourselves. We are going to keep challenging the status quo and seek smarter and effective ways of operating. We believe the future belongs to the apparel companies that embrace innovation, think differently, and continuously evolve to meet the ever-changing needs of the customers, market, and the industry. So for India, our near to long-term strategy is 2 times revenue with higher PBT. And for Bangladesh, we are focusing on optimizing, we are focusing on product capability, and moving up the value chain and drive better profitability. We are also exploring strategic joint ventures for manufacturing in Egypt and Indonesia with other global partners to create a platform where we can offer a broader portfolio of products and across the countries and align with the buyer sourcing and manufacturing strategies. This is our core team. I've always loved the analogy of a ship on its voyage. While I may have the privilege of being its captain per se, I call myself the chief enabler. I think the success of this ship will not be possible without the dedication, commitment, and the professionalism of its crew. So in Mansi, our CFO, I see a trusted navigator who's going to ensure that we maintain our financial discipline and stay true to our course. In Manoj, who leads our Bangladesh operations, I see a chief engineer working in the engine room and driving operational excellence and keeping the engines running. In Vijay, I see our explorer constantly looking beyond the horizon and identifying newer opportunities for growth. I'm very fortunate to be sailing across some of the finest minds in the industry, and I can tell you from confidence that the future can only be brighter. Thank you so much for your confidence in PDS, and thank you for your time this afternoon.
I think we shared a lot of information, and thank you for having the patience to go through all these presentations. But hopefully gives you a better overview of overall PDS is heading and some of the flavor from our business partners, what they're doing to navigate these challenging times, but also come out winning as businesses, where many businesses would have struggled to adapt, where we are seeing our business as being completely resilient and also gaining from all the disruption happening and becoming strong in the years to come. So any questions anyone would have, we are happy to answer, please. Yeah. Can you bring the mic?
Hello.
Yeah.
Yeah. Okay. Thank you. So my first question is to Mr. Palak. So when you said that you want to make company for 20 years, maybe more, so I want to understand, like, for a company to grow, first there's time available, then there is a trend, like maybe long-term tailwind consolidation or maybe outsourcing, and there is the strength of the company, and there are the challenges which comes in normal period of time. I want to understand, like, if you're going for 10-20 years, I want to understand the TAM of the PDS. So how to go for $5 million, and from there also, like, give me some examples. Like for example, I heard your Primark 5% of their sourcing, and they may be 20% outsourcing, and rest may be from their own department. So you become 20. How to grow from there? Like I see Mr. Lee presentation. So there are departmental stores, there are brands, and there are D2C. How to, because this sector retail itself is not going to grow leaps and bounds. So we have to take the wallet share from different geographies, different segment, and we may have addition of new line of business, which I am not counting because it's very difficult to me imagine in that. So is the 5 billion maybe a base there, or maybe 10 billion is the base there? So I want to understand that part of it.
So the good thing is the question you're asking has conviction that PDS will become a $5 or $10 billion company.
So that's why I'm interested, but I want to understand the other part of it.
So the good, the reality is that today's day and age, the markets are consolidating, retailers are going out of business, and few are emerging as strong players. If you're a strategic vendor to those retailers who are becoming stronger, you are there to win because they also want to consolidate. For example, a retailer had 300 vendors, their top 20 or 70% of the volume. And the balance 300, they want to make maybe another, get rid of, say, 150 and have only 100 vendors. So there's a big consolidation happening. In that consolidation, in 2 years, PDS has opened so many large accounts, right? Where we don't want to add a new vendor, they've opened PDS accounts. So that's already a very important step in the right direction, because I don't think we've been to a customer presentation and come out saying, sorry, we don't want to work with you. Every single customer presentation, from M&S to Walmart to PVH, to whoever we pitch, now JD Sports, they're all like, great, there's a great business. We'd rather work with professional companies who are financially stable, who are global and able to manage risk. So that's great that we've been able to add those accounts. Now comes to our business model, like all of us can have as many lunches and dinners with senior leadership of retailer. They'll entertain us, they'll meet us, they'll do that. But unless we have motivated team and investment in people, we can't really grow with them. So which is what we've done last 2 or 3 years. You've seen the quality of people we've hired. Those people are very important because not only at the leadership level, we should be able to engage with them, but the teams we have brought on board are some of the best in class teams, then can man mark those retailers' buying teams and give them the confidence that we can deliver to their requirements. So, you know, it's good to have a 3-year, 5-year, 10-year strategy, but in our industry, every year is 4 years. Every quarter we are starting from not zero, but we have to deliver every quarter, right? We have to, like a manufacturer also, every 4 months they have 0 order book. So, you know, short term, making sure we have operational excellence, and mid to long term, we have strategic relation with these big retailers who open our doors and relying more and more companies like PDS to give them services. So luckily for us, we are the only company globally set up now as a services business that can engage with retailers at a strategic level and provide them solutions. We are not a factory in middle of Asia, you know, having like selling capacity. We are not selling capacity. We are selling solutions and services. And fortunately, we say we are like a KPMG, PwC, E&Y structure today. They're not 5 big 4s or not big 5s. We are only 1, right? So there's no fight for talent. There's no equity model like set up globally. And there's no company leading with retail at the professional services we are doing. So we're very confident about the, you know, short, mid, long-term strategy. All the investment phase is more or less behind us, right? Which we have seen. Some things like brands business has costed us a lot because of customer bankruptcy, like Gary Weber, Rajiv showcased how a company went bankrupt, but he still was profitable in that year. Ted Baker, we are resolving, right, because of customer bankruptcy. Within next 3 months, we will have a solution which will be, you know, solving our issue. Manufacturing was a challenge. We are great factories, like, but we didn't have the right capable management to present them. So with Abhishek joining, now we are a manufacturing first business. Our capability of a management team in manufacturing is best in class to any other manufacturing group out there, which we didn't have like few months ago, right? So we've taken all the corrective steps and we feel we'll come out winning in a market that's tough, but are requiring solutions and with a weak competition set.
Can I ask one more question?
I mean, we are running out of time, so maybe let the gentleman talk and then, yeah.
So, when you speak about challenges, if you can highlight a little bit more specifically, because if you are doing all things so right and it looks that, you know, you're attacking it from all angles, then what are the current challenges that you are facing from the side of the customers, and what is it that is not working for us to really grow? And the second connected thing here is that, you know, the bankruptcies in the retail sector across the world are not new. It is not just this 3 years. If we take 15, 20 years of history, most of the time this keeps happening. So this translates as that even if we are growing and adding accounts, somewhere we will be subtracting accounts all the time. What are your views on this point?
Yeah. So I think the biggest challenge, you said your second question only, the customer bankruptcies. It is true, it's been happening over many years, but since COVID, it accelerated 5x. For example, in UK alone, if we give that market, we could have sold to 30 retailers pre-COVID. Today, there are 8 left. So, you know, 30 survived so many years, and in last 4 or 5 years, only 7, 8 are left. But those 8 have become stronger, right? So macroeconomically, there are retailers who are going out of business. As long as we are strategic with the players you are winning is very important for us. Second, there is a lot of pressure on, you know, second-hand clothing sale, you know, platform like Shein and Temu going directly to consumer, smaller quantities becoming important. So I think there are a lot of disruptive challenges in the industry. But the way we are positioned as a business, you know, as long as we are partnering with the right retailers who are growing, you know, because the market is not shrinking to the level the customer bankruptcies are happening, I think we'll still end up winning, you know. If I was not able to open those accounts the way we are structured, then we would be worried that PDS has not been able to open a Walmart or a M&S or a H&M. You know, these guys don't work with companies like ours. Normally they work with factories. They made exceptions to work with companies like ours because they see a value of what we provide, and the teams that engage with them are best in class. So I think a lot of good ingredients are there. But yeah, challenges are there all the time, you know, but unless there's disruption, there's less opportunity, right? So Sanjay maybe can add.
I want to add just, I think 3 points are coming to my mind. As Sadiq shared, notwithstanding the bankruptcy or any challenges, 12% heavier CAGR over last 5 years and 15 years as well. So I think that kind of growth is maintainable, is weatherproof. Bankruptcies didn't happen. Gary Weber is an example. Metalin account got shrunk. it impacted us. We all felt far more severe impact last 2 years because on one hand, these two situations, plus we had accelerated our own P&L based investments. So therefore one felt the crunch on profitability. Palak and Sadiq covered about how guarded are we now in terms of investing into new verticals. So one will have to stay with bankruptcies, but you will observe a P&L now far more resilient now to overcome any such situations. I think we've learned our lessons and the guardrails are well in place now going forward as well.
Hi, sir.
Hi.
So I've got one major question with respect to EU FTA. I think so there are regulations which EU has been implementing for getting digital passport QR, which is mandatory for a lot of brands. They have to have it on the product, and as well as extended product, tracing and having minimum recycling content, etc. So with all these regulations, do you still see increasing wallet share from all the top brands like H&M, Primark, M&S, or do you, because for them, they do go directly, and I think so that's bulk of the share, but I think so since we can do it on a mass scale and we can do it at lower cost, it's better for them. So A, out there, and B, do you see a lot of small brands also being added to the portfolio on a sustainable basis where you see they can honor the contracts? Because I think so it's going to be a very big headache for them to get all these sourcing done. And C, Shein, Temu, and other brands who are not that compliant, do you see them being able to comply with all these regulations on a very stringent basis?
Does anyone want to take the question? So maybe Rajiv can take it. Like give option to others.
Firstly, on the EU FTA, yes, on the supply chain transparency, there are certain laws, but they also have realized that across the board they can't implement it because the bureaucracy which needed to give this transparency. So they have actually gone back from what they had decided and given more time for brands and companies to adjust to the supply chain transparency laws. So that's one part. I'm very confident. We have already worked on many of the softwares. In fact, one of our investments is in the digital product passport area. We are on the forefront of those technologies which will support to enable these supply chain transparencies. So I think that when these laws will finally come, we are very well equipped to handle them. And I think that this will also support Indian manufacturing. The FTA agreement seems to be in place by December, latest March, and that when I'm looking at the capacity building in our Indian manufacturing, it's going to support us on that. I think that was the thing. Third thing was on the Shein and Temu regulations. I was recently at the World Retail Congress and the Trade Minister of Germany was there and he announced that from June onwards, they are going to implement a duty on the packets which are coming from Shein and Temu. So EU is also realizing the problem which is there. Unfortunately, as all of you know, it's a very bureaucratic organization, it takes time. So we are very hopeful that at some point of time they are going to put all these transparency laws also to those products. And then we have a level playing field which is more equal than where we are today. So it's a bit of still work in progress, I believe.
Hi, I've got a question regarding, okay, so let me really stand for you. I've got a question regarding the cumulative profitability that the site which has been really, played. And if you really look current year, it's hovering like PBT close to around 0.8%, and then the next year it is going down further. And if you really look at that, the PBT itself is really hovering. By 2030, the target is 2.5%, and then by 2032, it's going to be around 3.63%. So my question is that what is that something which is really done by the company to improvise the profitability and the margins? Looking at the model means it's very promising. Obviously, that servicing platform itself should really be a cost-plus model where the profitability can really get pre-decided, but at the same time, that's not really reflecting in the numbers. So what is exactly done by the management on that?
Rajiv and I had coffee last evening, so I'm trying to answer your question with a real-time example on a lighter note. And I met a little worried colleague in terms of his profitability. And so this morning I had a paper for him, and that's where I'll try and answer your point. 3 verticals of PDS, all existing. One is crayons catering to US market, circa 70 million top line, makes 10 million gross margin on 70 million. There's another vertical called Clyder, running from Bangladesh, 40 million top line, makes 9.5 million gross margin. Okay, both making similar. Rajiv is 100 million top line, 11 million gross margin. But the previous 2, Clyder make 8% PBT margin, okay? And crayons make about 7.5, and Rajiv is closer to 1. So I said, Rajiv, while we should gun for more top line, for sure from 100 to 150, he said he's going to do 1.5 times. But there is juice from within. And here are internal real-time examples as to how I can squeeze cost from within, to try and take up a 1% PBT. He's done very well to fully recover and come out of the Gary Webb shock, but there are internal 2 examples as well. So I think to answer your point now, leave apart the top line growth, leave apart the operating leverage. There are going to be cost efficiencies. BCG has helped us, arrive at that. So therefore, cost efficiency on the procurement through Project Pulse that we talked about. Palak touched upon that we have peaked our P&L-based investment, and we should only see improvement, which means straightaway addition to PBT as well, and going forward, calibrated investment. So procurement efficiency, calibrated PBT. My colleague talked about that unless US increases interest rates, he's very confident that the interest amount has peaked out for us. So I've just touched upon 1, 2, 3 levers on the whole, and one example from my friend here as to how we can. I think combination of these, you will not see suddenly a profit jump, but when we aspire to a 5% journey, we are 1.2 latest, but you should see us every year now moving closer to that trajectory, 50, 75 basis point improvement year over year through a combination of what I just mentioned.
Thanks. So Palak and team, thank you very much for all the detailed presentations over the last few hours. It's been very helpful, and I appreciate all of you coming together. Palak, my question is to you. Obviously, it takes a lot of effort to put the building blocks in place, which you've done in terms of attracting the right talent for each geography, each vertical. Of course, your sector is, there's a lot of complexity in moving parts every quarter, as you say. So if you look at the next 3 to 5 years, is it fair to say that there might be a little more focus on just putting the head down and executing, because every new element that you add, building block or leader or geography or vertical, it adds to the complexity. So is it about time that the foundation has been put in place and the execution over the next 3 to 5 years truly unlocks the potential of what has been a very carefully put together platform, highlighted enormously even by Mr. Lee's presentation about how outside of Lee and Fung, you are the guys. Thank you.
Yeah. So I think, we have reached that size and scale where we can add another $1 billion top line with very little incremental overhead, right? So that's what we've been able to create. We've got the leadership, both at the platform level and the vertical level, the quality of people management we have the customer engagement, we have the accounts open. So normally, you have to almost, for the first turnover growth, the top line and the margin, all cost goes in line with the margin. But now the cost base is there. Most of my businesses can double, triple in size with very little incremental overhead. So if we get operating leverage, on one, the cost side. Second, we add the customers and give those opportunities to the existing verticals. You saw also I mentioned PDS Investors growth and partnerships team, which is just 2 or 3 people sitting in these key locations whose job is to just sell the PDS services. Go and talk about PDS to the big retailer. This is what we do. So example, Family Dollar, the big, Friends supermarket we signed, the big UK sport retailer we signed. These all are 3-4 month engagement from platform with customers to tell them that this kind of business exists, that the service you are able to give. So we don't need to add more cost. We don't need another Michael to join us or Anuj or Rajiv. The building blocks are there. It's adding $1 billion turnover, very little incremental overhead, and that will happen next 2-3 years. So, if I do another $1 billion with 14% gross margin, that's 140 million coming to the bottom line. I don't need to add costs of that level, right? So this is where we see the operating leverage coming in.
Got it. Thank you very much. All the best to the entire team.
Thank you.
Thank you. Sorry, I didn't introduce myself. I'm Namit Arora from InGrowth Capital. Thank you.
So we will take one last question.
Hi, good evening, everyone. So I just have one query, or rather one question, like excellent presentations. But as PDS continues to scale globally, like how do you see the balance between preserving the entrepreneurial freedom at a subsidiary level and also like, enterprise-wide transparency and consistency over here, like at central level?
We are only interested in managing two things, compliance and cash. Treasury centrally and risk management, ethical, social compliance centrally. Except that, we don't want to interfere in our business partners. We want to give them a free hand to operate, take quick decisions. Our customers describe PDS as artificial intelligence. They're like, you guys keep growing and crawling, in a very organic manner. That's how our customers describe our business, which is, a great testament to how the operating model is. So yeah, I think if we just take care of, make the platform leaner, make it more consultative basis than authoritative basis, but be authoritative, which manages risk and repression, which is banking limits through, credit risk management and treasury, and ethical social compliance. Except that, why do we interfere in? Our interests align with our partners. We are all equity partners in the same business. We trust each other to operate how they're operating. So that's my take on it. Maybe Rajiv can add, please.
There is one very large advantage which we have. We are always learning from each other. And that's something which really helps us. Sanjay talked about, how it's happening in the other vertical. And this is the spirit which keeps us also growing and doing better and better. And this is very unique in the industry. It doesn't happen like that. Thank you.
Thank you.
Should we close the session or any last question? I think the gentleman in front wanted to ask. Let's let him take.
Thanks, Palak. Thank you for the opportunity. I just thought, continuing on the trend of, what have you changed or what did you think sort of was not working or was a misstep in the US side, if Michael and you can just elaborate, since say May 2025 or somewhere in that time frame when Michael joined, what are the 2 or 3 things that you've changed in the approach to the US market?
So maybe Michael can answer that also, but quickly from my side, US market building blocks are already in place. We had Mark Green before, he helped us establish and make a lot of those relationships, but there was no execution capability, right? So when Michael came in, he bought in his goodwill. When he and I go pitch, no customer says you can't do it, right? So we complement each other's strengths. He's got the backing of a platform, and he's got great CV and execution capabilities to work very well. What's not worked last 2 years is the brands business. So of the 30 million investment we've done in P&L, 19 million has been brands, which is where we cut and, by end of this financial year, 31st March, except Ted Baker, we are restructuring. Most of the other businesses, either we've exited or given IP. So the core business of design-led sourcing of service is working. We're running 6 months behind, in some cases, but that's structurally okay. It's just the brands business where what Anush presented, as long as we have a brand with a retailer and there's a tri-party arrangement, it works beautifully. But if we take a brand without a retailer in mind, which is backing us, it becomes a liability. So maybe Mike.
Yeah, sure. I think in the US, on a high level, it's basically consolidation and winners and losers in some of the areas, right? And that consolidation has helped us from a perspective. Many of the retailers are looking for strategic partners over long term, because they also need to, from a supply chain perspective, cut costs, get faster, get better value and so forth, because the whole environment is very difficult. So it's actually helped us. Mark Green, I think, helped in terms of the foundation, right? Some of the areas that we started. So I believe I was able to, with my team, of course, help to kind of take that further and faster. Partly is the environment, to be honest, because the environment now, supply chain in the US for retailers, it's a CEO level conversation now. Before it was maybe head of sourcing, now it's a CEO. So we've been able to have those kind of very senior level conversation. And as you saw in my presentation, with the help of PDS platform, in a very short time, able to get a lot of customers on board. So our focus as a vertical subsidiary, similar to PDS, I would believe, is more now operationalize it and consolidate it, and also make sure we scale. So that's kind of my focus in the company that we're working, because we've opened enough in terms of the customer. We'll obviously take one. We won't turn down customers unless they don't pay us or the credit issue. But the bigger growth is going to come, and the profitability is going to come from kind of take advantage and consolidate and scale. So that's kind of where my focus is right now. But the market is, I feel, tremendous in the U.S. because they're looking for companies like us, and there's not many companies that have all the capabilities. And I present it as one of the subsidiaries. There are others that are doing business like Rajiv is with some other brands. So I think with a combination of the talent we have, we can grow the U.S. market to a very, very significant portion of our overall business. So.
With this, we will close the Q&A session. Please be on stage for a group photo.
Thank you, everyone. Thank you so much. Thank you.